whole dynamic of the incredible expansion, the stimulus, both monetary and fiscal, that we got in 20 and 2021, if you look back at the charts, it tells you that actually the countervailing force of all this tightening over the last year, you're still in the point where it's got to flow through. And so for us, the net out of that is that, again, it's very difficult to predict the macro right now, but the Fed is certainly, as Mike has pointed out, if the inflation data doesn't heat up again, in a mindset where, yes, we're not going to cut, we're going to keep markets on guard, but we are waiting to see how it develops, and that basically means that earnings and valuations and sentiment matter more.
Pooja, just real quick here, are 6% Fed funds rates pretty much off the table?
Well, at this point, never say never. Yes, it's definitely not a base case. We still have two additional rate hikes that we've penciled into our baseline. So that takes us to about 5.75% by the end of this year. But, let's say inflation, remains persistent. We're not seeing much signs of labor market slowing. And if the FOMC, it truly wants to show its resolve in that it is determined to bring prices down, then, we can't entirely rule out additional rate hikes.
Pooja Sriram of Barclays, thank you. Michael McKee, thank you so much for being with us. And Julian, that seems to be what a lot of people are saying, is that kind of the Fed is not done, but getting there. And as a result, they're not as important in some ways.
Well, at a minimum, if we have less volume of Fed speak, at least we can concentrate on fundamentals a little bit more, which is why this isn't a bad week.
Okay, honestly, though, you say fundamentals, but everyone's going to focus on the presidential race. People are going to talk about everything else. I mean, come on, you know that, right? Talk about the headset from Apple, whether they're going to buy it, whether the kids are going to want it. Dan Ives of Wedbush is going to be talking about that next.
That's the life of mixed reality, Lisa.
Of enhanced, in augmented reality, you should say. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Yes, Apple is set to extend its losses after the iPhone maker launched its much-anticipated mixed reality headset at an eye-popping price of $3,499. While analysts were optimistic about the product and technology, they acknowledged that the price point was high and that it would limit the number of shipments in the near term. Meta's industry-leading headset sells for $1,000. The suspension of the federal debt ceiling is presenting a fresh challenge for U.S. banks. Lenders are struggling to hold on to deposits as customers opt for higher-yielding alternatives. Money market mutual fund assets have soared to an all-time high. They've been quicker than banks to pass along to customers the highest interest rates supported by the Federal Reserve's policy actions over the past year. Morgan Stanley is planning to move to a new office in Singapore as it looks to expand its presence in Asia. Bloomberg has learned the company is in advanced talks to take over 5 floors of towers currently under construction. A boom in private banking, family offices, and other financial services during the pandemic has boosted demand for swanky offices in Singapore's business district. In China, hearings begin today in a Tesla lawsuit against a protester who climbed on a car at the 2021 Shanghai Auto Show and shouted that a brake failure had almost killed her family. Now, that incident fueled online criticism of Tesla in China. Tesla denied the claim and filed a case against a protester seeking $700,000 in damages. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
So in the same way that Mac introduced us to personal computing and iPhone introduced us to mobile computing, Apple Vision Pro will introduce us to spatial computing. This marks the beginning of a journey that will bring a new dimension to powerful personal technology.
Apple CEO Tim Cook announcing the company's new Vision Pro headset, which retails for $3,499 and is set to launch on the next phase of products. We are here with Julian Emmanuel, Tom and John, both not in today for surveillance. We'll be seeing John at the 9 a.m. hour when he broadcasts from PIMCO's headquarters in Newport Beach. A bit of a softer tone ahead of the open, but nothing particularly remarkable. And really what has been notable, Julian, has been the run-up in tech shares, has been the run-up that we've seen more than 40% gains in Apple, getting those shares to record highs, touching a $3 trillion valuation. Does it have legs? Does it feel real to you?
Well, look, there is no question about the fact that, you go back to the end of last year when AI, generative AI basically came into the public where we could get on our phones and ask a question. It's changed the psychology, and whether it's, exactly like 1998 to 00, or it's just sort of a lesser echo, there is definitely a psychological transformation, and obviously that's helped with the market cap of a lot of these companies.
One person who's gotten it right considerably, and every single time, was Dan Ives, who is senior equity analyst over at Wedbush, who has come out with one positive prognostication after another. How much do the bears hate you?
Oh, I mean, it's kind of been a bear hate party, and ultimately, look, I appreciate it, and obviously, look, some of the smartest people I know are bears. I just think it's something here where the shorts, the bears, they came out of their caves last year, and obviously feeling really good going into the year. And my view is just it was going to be a lot better than fear in terms of overall tech spending. But it was our view, and we've talked about it, that it's the most transformational trend we've seen in tech since the late 90s. And I think you just can't fight that. And that's why I think names like Microsoft, NVIDIA, Apple, and others continue to go higher.
I have to say that some of my best friends are bears was always sort of the prelude to something negative that's pretty significant. I'm curious, though, after the announcement yesterday, you're still doubling down on some of the artificial intelligence embarkments of Apple, saying that this is where they're going next. A lot of other people didn't necessarily take that away from the conference. What gives you confidence that that's kind of the next phase of their explosion in valuation and growth?
And I think that's typical, right? I mean, for Apple for many years, I mean, for the last decade, there's many people I know, they've sort of fought it because they'll go to a conference, they'll just see a leaf. They don't see the forest or the trees. And I think essentially what Cupertino and Cook are building here it's another ecosystem within the App Store. And it all, because Lisa, right now, there's a battle, a Game of Thrones for developers between Google, Microsoft, in terms of what we're seeing in terms of this $800 billion AI revolution. Apple understands that. That's why they have the gold install base and they have the developers. This is the first step on a broader strategy, really to build another moat for developers and consumers.
So, Dan, obviously, you've the big five, big seven, however many stocks you want to target, who have really capitalized on this last number of months of AI momentum. Who among sort of the second tier of maybe those companies that haven't yet fully realized the potential do you see as being most attractive first? And then the second question is, what industries in specific do you think are likely to benefit over the next year or two?
Yeah, a great question, because I think right now, okay, the first derivative, the New York City cab driver was Microsoft, NVIDIA. But so now it's like who the second, third derivatives. I think ultimately Salesforce is going to be a big derivative that no one's talking about. I think you have names like Palantir, which is another on the AI front. And I think what you're really starting to see right now from a cybersecurity perspective, it's really, as more and more moves to the cloud, more moves to AI, you're going to have huge benefits there. Names like Palo Alto, Fortinet, and others. That's why I believe this is not just, today it's 5, 7, 10 stocks. When we look out over the next 1, 2, 3 years, I think this is really what I view as like a 1995 moment, an iPhone moment, relative to where we see it over the coming years. Obviously, macro aware in terms of what we're seeing in that, but I could tell you from talking to developers, enterprises, what we see in spending, I continue to view as a green light for overall tech stocks.
So this is a faith-based kind of bet, though. At a certain point, right, this is faith that AI is going to be a transformational moment more than, say, the adoption of $3,500, augmented reality sets that people are maybe not going to buy their children for the holidays. I'm just saying personally. But I'm just wondering, from your perspective, it's not about one product. It's about sort of engaging in a whole new way of doing business and getting out front so that different companies can use your technology, software, whatever you have, in a way that transforms the way they do business, correct?
Yeah, I think it was faith-based till the guidance heard around the world, the NVIDIA, the $4 billion raise. That's where basically all the bears went into hibernation mode for the winter. And that really is what really changed everything for tech, because that was the numbers. And now in Redmond, we're going to see it. Google, we're going to see it these next few quarters. And that's why I can tell you a lot of investors, they're not looking at the next 1 to 2 quarters. They're looking out over the next 1, 2 years. And that's why this really created the opportunity in terms of a market where I think many is still yelling fire in a crowd theater.
What do you say to the clients who are worried about valuations?
So it's the same clients I've talked to over the last 22 years where I'll sit down, they'll like on transformational tech names, on the Amazons, the Googles, the Teslas. If you look out over the next year on transformational tech companies, you'll miss every transformational tech stock the last 20 years and the next 20 years. It's no different than coming out of 2000 draft 6th round out of Michigan Brady, that first camp being like, I just don't know if it's going to work. So I think that's sort of my view in terms of how you have to look at these transformational tech names.
So from your perspective, Julian, are you sort of buying into this? Do you feel like you kind of have to be overweight tech even after the rally?
So we've taken a little bit of a different tack, right? So for us, we realize that the momentum aspect, whether it's 1995, and frankly, if you think about it, if Dan's right that this is 1995 and not 98 or 99, we have a lot further to run. Or if it's later in the cycle, we like the kinds of names that have actually shown both price momentum, earnings momentum, and for us, very importantly, in a momentum-driven market, still defensive positioning. Okay, and by that, whether it's a bid to puts or high short interest, and actually you get a number of sort of the second and third tier technology names that Dan mentioned, as well as actually other industrial names that may or may not end up using AI more directly in the immediate term.
When you talk about positioning, that is what a lot of people talk about. The overweights right now for the big tech names have gotten fairly extreme. Suddenly, everyone's piling in because as much as the bears might be more vocal and the ones reaching out to you to say, no way, and with all sorts of hate mail with lots of expletives, most people are saying, all right, we buy it, we're in. How much is that going to potentially challenge the ability for these shares to really rally, even if people buy into this story?
Look, no, but I still think, institutionally speaking, many have been sitting on the sidelines with their 6 reasons to be negative, and now they're like, maybe they could focus on the weather, hurricane season as a reason to be negative. I'm just trying to think about like other reasons to be negative. But so I think what's really starting to happen now is you're looking at the derivatives. You look at Apple from a sum of the parts perspective. I think there's a stock that continues to go much higher. You look at now, the macro is not rosy and rainbows. We know that. But I think what's starting to happen here, when you look out the next 4 or 6 quarters, if you pick, look, there's going to be fakes. There's going to be names that basically like ultimately fake it, and then ultimately that's the froth that will come off. But if you pick the winners, you pick what I view as the fundamental names to really own in cloud, cybersecurity, and AI, I think that's how you win here.
10 seconds. When does Apple become a $4 trillion company?
Look, I believe right now you could rationalize $3.5 trillion. I think by 2025, we're looking at a $4 trillion or sooner.
Dan Ives of Wedbush, really putting the bears back into hibernation as we continue to see this rally over in the tech shares. It is interesting, though, Julian, that we're not seeing any kind of interest rate sensitivity really being talked about anymore in the tech sphere.
Again, it is one of these times where there is a perception of accelerated growth and opportunity. And frankly, when you think about it, one of the best things, and we talked about this earlier, the fact that macro matters less, is that we flatline in terms of yields. Let's leave it be calm for a little bit longer.
Let's leave it be calm. And anywhere other than the big tech names, where Apple charted a new all-time high. Those shares lower by about 0.6% this morning, but just off some of those records.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
And you're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably couldn't spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very so yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Markets, after they've run this much, they're always fragile, right? So you're looking for the next shoe to drop.
I do think the Fed is driving us towards a stall speed in this economy. And when you're at a stall speed, you become unstable.
The Fed is behind us. Maybe they hike once more, maybe they hike twice more, but that's it.
I think the Fed being on hold just should not be confused with job done.
The soft landing can't be ruled out. I don't think it's ever been able to been ruled out entirely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's a return of the soft landing. I can't believe I'm saying this. Everyone seems so constructive this morning. Good morning. Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Jonathan Farrow, Tom Keene, and Lisa Abramowitz. But John and Tom are both off today. You are so lucky because you have me. So what more do you need? You also need, of course, Greg Peters, co-CIO of PGIM Fixed Income, who will be with us for the hour from your wine club off in London, joining us here on set. Do you buy this sort of constructive feel that everyone seems to have right now?
I kind of do. The debt ceiling, which was a unforced error, so to speak. The data continues to be pretty strong. I think we're closer to the end of the hiking cycle than the beginning. That's an obvious statement, of course. So I feel like we are in a better place for a little while, but there's still a lot of uncertainty in the future. But I feel like we're in a pretty decent place over the near term.
I feel like we just spoke with two equity analysts, and the optimism was just overwhelming. It was basically just, threatening bears out there saying, look, you're getting it wrong, and you're going to keep getting it wrong. Do you take issue with that? Do you think that optimism is misplaced, or do you kind of jump on the same boat?
Well, it was rather optimistic, I will say. So I'm not quite that optimistic, but I do see maybe the recession that's been talked about now for, I think, the past 18 months pushed off. And that's the curiosity in the bond market and the pricing, right? So the markets are pricing in another hike and then cuts, which implies that the Fed is going to admit in a few months' time that they made a catastrophic error, the economy's rolled over, and they have to cut. So to me, it's not about whether you're bullish or bearish. It's about the incongruency of what the equity and risk markets are saying versus what the bond market's saying.
And that does seem to be something that we see on an ongoing basis. Today, you are seeing a return to the 60-40 type of feel, where it's actually working, a little bit of an inverse relationship with stocks just slightly softer in the pre-market trading, and you are seeing bonds just getting a bit of a bid, perhaps after the ISM data that came out yesterday that was a bit softer than people had expected in the services sector. You are seeing a bit of dollar strength, although I got to say this pair has been pretty stagnant at 106.97 or close around 107 to 106.5 over the past few years, a few days, I should say, days. It feels like the same pretty much. And crude a little bit lower right now after people reassess the cuts that we heard from Saudi Arabia. I do want to talk about the optimism that you're seeing from some of the stock market bulls, and then also the pessimism that you're seeing implied by some of the yields. And I want to bring in our next guest. Before we do, I just want to let you know John Farrow is in Newport Beach hosting the Open from PIMCO's headquarters. He'll be speaking with CEO Emmanuel Roman, CIO Dan Ivison, and former Fed Vice Chair Rich Clarida, among others. That will be today at 9 a.m. Eastern. Today we get annual shareholder meetings from Zillow, Urban Outfitters, Freeport-McMoRan, and Palantir. Palantir, interesting with the AI. And today, former New Jersey Governor Chris Christie expected to jump into the race to become Republican candidate for president. How much are you watching all that, Greg?
Oh, I'm watching it pretty closely, actually. I think it's a curiosity, number one, and then number two, I do think it's important, right? So, I think the next presidential race, where the House and Senate continues to evolve, I think is incredibly important for markets, the economy, particularly on the global stage. So I think it's really, really important, Lisa.
Well, we'll be talking about that throughout the day. I do want to get to our guest, Anna Hahn, who's also sitting with us here around the table, equity strategist at Wells Fargo Securities. Anna, so good to see you in person. It seems like everyone's getting back in person, which I have to say, I absolutely love. You're not quite as bullish as some of the others. Why?
Well, we do have a price target still of 4,200. It's a little below where we are in the market now because we do expect a pullback. I think when you asked Greg before, is his optimism misplaced? I would say more it's concentrated. It's concentrated in this one part of the market, which is very tech, very AI, and very growth oriented. It's really been, maybe 5 to 10 names holding up the market, leading this rally. And if we don't see that breadth expand, that's a cause for a pullback in our book. And you mentioned as well, people are kind of maybe staving off that recession another 18 months or more. We still expect something. And with that, there still is that concern that if the consumer gets hit in the pocket with labor, that is really something that we have to consider might cool the market a little bit.
How much is this that tech names you don't see continuing to rally versus the others catching up, right? Because they are so dominant at this point. It's basically where the tech goes, so too goes your S&P forecast.
You're absolutely right, Lisa, and that's the hard part. We have a market index of S&P 500, which is driven by market cap weight. And when you have these huge names in the index, that's what makes it difficult. Is this really the indicator of the health of the U.S. equity market, or is it the health of just these select 5 top 10? So when we think about the rest of the market, it brings a little concern to us to see that there are weak parts. And in particular, you've brought a couple of them up before. You've mentioned some of the risks, and these are things we have to keep in mind. So we're not quite ready to move our price target. We're holding pretty firm 4,200, and we do think it's still going to be a little bit of up and down ride for the rest of this year.
And then how sensitive do you think the equity market is to rising rates? So last year, the market was all about rates. Stocks had duration to it. Now no one cares. What is the importance of rates into your forecast?
I mean, absolutely crucial, Greg. There's this beta to the equity markets when we think about how much do yields impact. And you saw, like you said last year, yields up, growth markets down, so equities down because growth is such a big part of the equity market. What's been kind of confusing has been now you've seen yields go back up, the 10-year trickle back up 20, I shouldn't say trickle, I should say really trend back up 20, 30 basis points just as markets start pushing out the possibility of cuts. And yet at the same time, you have growth leading the market. It's this thirst for AI, this exposure that people are so trying to get and reaching for, that's been these two clashing forces. So the question is, when do those fundamentals kick back in?
The problem that I keep struggling with is I've been looking at credit markets, which supposedly lead, right? They're supposedly the ones that tell you when everything is going to fall apart. And what they're signaling is, it's okay. I mean, the names are going to struggle. You're going to see CCC not do so well, but you're going to see some other names do pretty well. People are looking at some resilience, some even potential growth, especially given that revenues are going up with inflation. Greg, it seems like it's not that negative, like things can kind of keep chugging along, even with 5%, 5.5% Fed funds rates.
The resiliency is just amazing across all markets. The credit market, though, is notable because the construct has changed, right? So if you think about where the risk has moved in credit, it's out of the high-yield bond market into the levered loan market and into the private market. So the risks are actually more opaque and therefore kind of less leading as they have been in the past. So I think the signal that credit has provided in the past will not be the signal in the future, just given the move towards kind of opacity, whether it's levered loans or private credit.
That's fascinating. And Anna, does that mean that some of the models that have traditionally been used to sort of forecast weakness don't really have the same clarity now, just simply because some of the readings are going to be muddied by trends like that?
I would agree with that. I think the traditional indicators we look at, the traditional parts of the market we look to guide us, be that canary in the coal mine, might not be as sensitive anymore. And you bring up a great point. It's like, have we forgotten that there still could be a lot of unrealized losses in the regional bank space, but yet credit markets are reflecting pretty healthy spreads. We saw IG spreads last month kind of do a round trip of 10, 15 basis points, but we're right back where we are. So these are the kind of things that maybe has equity volatility contained for now, but something that we want to remain cautious of and remain vigilant to stay on top of and in front of.
What would you have to see to become more bullish?
more bullish, I think we'd have to see a Goldilocks scenario that either we can keep unemployment very low, at the same time inflation can come down without the Fed having to do too much heavy lifting. But that's a patience game, and I don't know how patient the equity market or the consumer can be. So far we're trying to keep steady here and keep that patience. But if that can't occur, I still think you're going to see more volatility, and a VIX at a 14-15 handle is pretty hard to sustain.
Anahan, thank you so much for being with us of Wells Fargo. Always wonderful to get your thoughts. And Greg, I do have to wonder about how much more constructive you've become over the past couple of months. Is there a fear, and this is something that a number of terminal users have really raised, is there a fear that people are kind of being brought in just before the kill?
That's classic, right? So I do worry about that myself. I would say I'm marginally more constructive.
Okay.
But I do think the cross currents and the uncertainty, remain. But as a bond fixed income person, higher yields help out a lot, and so that is, I think the important aspect of my call.
But there's an equity perspective to it as well in terms of the credit side. Are you seeing perhaps less willingness to kind of go into the riskier areas, or are you kind of getting more constructive there too, just because of that incredible resilience that you're seeing in the economy?
Yeah, so I do see a bifurcation around risk. So I do see the more risky parts of the market, whether it's leverage or highly cyclical, definitely underperforming here. I think that makes sense to me. So if you actually look under the covers and delve in, you're seeing a pretty healthy rationality in market action. So it's not like everybody in the pool. Maybe tech and AI is a different kind of story altogether. But I would say broadly, there seems to be pretty decent differentiation, which I think is a healthy sign, not a poor one.
Do you feel like people who are in the market today are not used to this? They're just used to sort of waiting for the Fed to tell them what to do and trading on big macro themes and not exactly on specific names?
Yes, and I think that is where things can unwind quickly. I still believe investors are using an old playbook. If you look at what's being priced in the market in terms of rate cuts, to me that's overly heroic. The Fed and global central banks are fighting inflation. They just can't turn on a dime when inflation is above the mandate. So I think the markets are putting too low of a bar around rate cuts, actually. I think it's a big mistake.
That people are basically thinking that rate cuts are going to happen well before they actually do. Still seeing some rate cuts priced into the market by the first month of next year, even as people say, job not done. Greg Peters is going to be sticking with us of PGIM Fixed Income. Coming up in the next hour, Neil Dutta of Renaissance Macro joining us for the 8 a.m. period. And we're going to be taking a look at what is to come, including CPI on Tuesday ahead of that Fed rate decision. The skip, the pause, words matter. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine says Russian forces have blown up a giant dam in the country's south. That blast has unleashed a deluge of water, putting 10 villages and parts of Kherson at risk of flooding. Residents are being told to prepare to evacuate. President Volodymyr Zelensky summoned an urgent meeting of Ukraine's National Security and Defense Council to discuss that attack. In France, unions are holding a fresh day of strikes against Emmanuel Macron's pension reform. Now, it's the first nationwide protest in more than a month, and it will test whether the president has succeeded in getting much of the country to move on from the politically damaging fight. Macron has faced down months of protests and strikes. He angered many when he enacted the legislation without a full vote in Parliament. Deutsche Bank's asset manager DWS Group is expanding its efforts to offer work flexibility. That began during the pandemic. The company says it will let employees work outside Germany for almost 4 weeks a year. The move sets DWS apart from many other financial services firms, which are stepping up efforts to get people back to the office. BlackRock recently told employees to be on site for at least 4 days a week. And Eaton Vance is joining the ranks of major funds looking to the frontier of the investment universe to help boost its emerging market returns. Nations like Uzbekistan and the Dominican Republic are reforming their economies and institutions. Now, the firm says that's making their assets attractive to portfolio managers. Eaton Vance has moved to reduce its exposure to China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Today, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iverson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg, The Open, with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
You can advance your career more quickly by joining the field than by staying out of it. And, secondly, there's a why not me aspect to this where, what a lot of people sense here, a lot of these candidates sense, is that they're going to be, the electorate's going to be hungry for alternatives as Trump continues to be weighed down. And so there's a good opportunity for them.
That was Terry Haynes, founder of Pangea Policy, earlier this morning as we talked about the growing field of Republican candidates for president. And we're talking about Chris Christie potentially coming into the field today. And then a question around Glenn Youngkin of Virginia, the governor there, about whether he will also get in. Right now in markets, we are seeing a bit of a softer tone, but not exactly anything dramatic, no drama. We are seeing yields a little bit lower. Crude, interestingly, and I want to give a second to this, crude down about 2.2%, even after what we saw yesterday with Saudi Arabia coming out and unilaterally cutting production by 1 million barrels per day. John and Tom, both off today. We are here with Greg Peters of PGIM Fixed Income. Is that interesting to you, this idea that we have seen the softness in oil and even OPEC Plus's recent announcement hasn't really staved this off?
Yeah, I think it's a warning sign. And, we talked about being more positive on the margin. This is something that really makes you revisit that, right? So there's something in the market price action here. I think it has a lot to do with China, of course, but it is a global growth slowdown story as well. So I think it's hard to ignore the fact that the markets have, moved right past the OPEC plus cuts and continue to move lower. I think is really a worrying sign.
We're going to be continuing to parse that as time goes on. A lot of people thinking maybe this isn't exactly a permanent cut. It's just sort of a one-off, and that's part of the reason why.
It's a cheating anyway, and so it's not really a cut. And so you're seeing oil flow out of Russia and Iran, and so it's really not a true cut.
Or a lollipop or whatever people want to call it, all of the names. Talking of China, we have been hearing a lot in the tit for tat between the U.S. and China. And before we get into the rat race or the horse race, whatever you want to call it, in the political sphere coming into 2024, there is this easing of tensions between the U.S. and Chinese. And what you're seeing is some potential talk of meetings in Beijing to come to some more kind of communication, at least, to set the stage for a softening. Anne-Marie Hardern down in Washington, D.C. of Bloomberg is joining us now. I want to start there. We are going to get to the election later on. But how significant is it that there have been these talks by senior officials in both China and the U.S. happening in Beijing?
Well, I think one of the most significant is the fact that we have the highest ranking U.S. official to date since the spy balloon incident happened. This is an individual at the State Department who's in charge of Asia, meeting the vice foreign minister in Beijing. So they, according to the readouts, these are very frank and candid conversations, and it does seem that potentially, as you see the administration wanting to meet with their counterparts, this could be the laying of that groundwork. It also comes on the heels, of course, of other meetings between high-level U.S. officials and their counterparts. We had Gina Raimondo meeting her counterpart. National Security Advisor Jake Sullivan spent a lot of time with Wang Yi in Europe recently. And then, of course, there was this secret trip from the CIA director, Bill Burns, to China. So it does look like there is a growing of that outreach. But at the same time, Lisa, the rhetoric is very heightened right now. And we saw that over the weekend at the Shangri-La Dialogue in Singapore. Yes, there was a cordial handshake, but there was no sit-down meeting between the two defense chiefs of Washington and Beijing. And I think that's a question for the broader national security apparatus as well as business community. What does this mean for them if you cannot even have your two top-level military chiefs, which really ground zero and where a lot of the tension stems is in the Taiwan Strait. And we saw that as well this weekend with a Chinese vessel coming very close to U.S. warship.
As we gear up for the political circus that is the election, China-U.S. relationship when it comes to both Republicans and Democrats, how much splintering has there been? We have heard there's splintering over Ukraine aid. Do we get a sense of where the positions are coming out?
When it comes to China, you would be hard-pressed to find anyone in Washington or anyone on a campaign trail not wanting to take a tough stance on China. I think at this moment, it could then be very difficult for the Biden administration as they try for this rapprochement with China. Remember, we're still waiting for an announcement of whether or not Secretary Blinken is going to go. His trip got derailed because of the spy balloon. Treasury Secretary Janet Yellen told me she still plans on going to Beijing. How does all of that look? While at the same time, you are going to have questions to all of these Republican nominations, and that field is widening. It's going to be widening today when the former governor of New Jersey enters the race, Chris Christie. They are going to take a very tough stance on China, and they're going to want to do anything they do to say that the Biden administration is being soft on China. But of course, what we've seen over the past 2 years, the Biden administration has not lifted, say, the Trump-era tariffs. They've also went after China in terms of export controls and chips that could potentially use to the military. But it's going to be a place where China is going to be the foreign policy target for all of these candidates.
And then, Anne-Marie, how do you see the risks receding then, right? It seems like each candidate wants to be more hawkish than the next. And so how do we kind of get out of this vicious circle if everyone is talking tough on China?
It's a great question, and I think that's what the business community is grappling with at the moment. Dan Tannenbaum, speaking to Bloomberg, talked about this, saying, you know, a lot of this is optics. When you look at what happened with the comments from Lloyd Austin and Li Shangfu in Singapore, a lot of it is optics and this rhetoric. When you actually look at the hard data, you do see record trade between the United States and China last year. I would note, though, for businesses, it's going to get a little bit more complicated as they try to navigate this. They are still waiting on what's happening with the outbound investment restrictions from the United States and potentially other G7 countries. They've talked about this at the G7, not decoupling, but de-risking. But the news this morning is that Sequoia Capital is siphoning off its China business because they find the regulatory environment just too difficult? Are we going to see more businesses do just that?
Anne-Marie Herdern, thank you so much. As always, wonderful reporting from Washington, D.C. Greg, I do wonder about that, how much you can factor this type of tension into an investment thesis if it's sort of, kind of bipolar in terms of whether there are restrictions or not put on.
Yeah, and I think on top of that, you're entering this phase where China is no longer going to be the same kind of dominant global growth story that we've witnessed over the past 20 years or so. So on top of it all, you have a naturally maturing economic cycle in China that is going to have a different dynamic on the global stage. So will they fight against that, or will they kind of allow it to happen?
How much is that sort of influenced whether you're interested in global bonds, whether you're interested in Chinese securities at a time when they're potentially easing policy on the margins?
Yeah, I mean, that's important, but the bigger picture story is the growth that we've seen coming out of China is not going to be the growth in the future. And what does that mean for not only global growth, of course, but global inflation, labor markets, and alike? So, where to invest is kind of a smaller story. The bigger story is the influence that China has had. It will be very different going forward than what we've been investing around the past 20 years.
How do you hedge against geopolitical risk?
Well, it's very difficult, right? So the lesson learned last year was you have to pay attention to it, right? So in the past, you were rewarded as an investor to ignore it. But I think what happened with the Russia invasion is that you have to pay attention, and geopolitics is taking more and more importance into the thought process here. So it doesn't go away, and that's geopolitical and actually local as well. So just politics within the country, like we've seen around the debt ceiling.
Well, how much are you overweighting the U.S. and saying, this is home bias, especially when the risks externally are so significant?
Yeah, so I'm pretty bullish on the U.S. I think the U.S. wins and will continue to win. We like the dollar, we like the U.S., and we don't believe the story that the U.S. Dominance is fading.
Right now, we are seeing the dollar marginally higher versus the euro. We'll be talking more coming up next about the fixed income space with Colin Martin of Charles Schwab and just how much people are shifting back to the U.S. after going overseas for a lot of the earlier part of this year. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Tom Keene is on vacation. John Farrow is not on vacation. He is in California, and he'll be broadcasting from there at 9 a.m. Right now in markets, a bit of a softer tone as we sit and look at a quiet period for the Federal Reserve, but not anything but when it comes to some of the geopolitical action. We are seeing a bit of dollar strength. We are seeing a bit of resilience in the Russell 2000. What you're seeing in bonds is yields marginally lower after softer ISM data that came out yesterday, perhaps giving people a sense that there isn't this sort of runaway growth being fueled by the services sector. 10-year yields 3.67%. The 2-year space just basically stagnant at 4.5%, a little bit below that. And what you're seeing is a bit of euro weakness versus the dollar, but really sticky in terms of a level. This has been really notably sticky over the past couple of days, 106.91, as people try to understand whether the ECB is going to stop cutting rates later this year after they see inflation coming off just a little bit. And taking a look at some of the names that are moving this morning, it basically is a retracement of Apple and a retracement of NVIDIA, just marginally with both those names down, less than 0.5%. But I'm really watching Exxon in particular. Those shares lower by more than 1%, following on from already a pretty underperforming kind of level this year, even after the cuts that we saw from Saudi Arabia. I'm so glad to say that today we are joined by Greg Peters for the 7 a.m. hour of PGIM Fixed Income. I mean, honestly, I keep looking at this market and I just think it's going to melt up because that's basically what's been happening every single day.
Well, lack of data should help that along, and the summer quiet period might help that along. But we still have the Fed, we still have inflation, and the data is very, very mixed. So it might not be as planned, Lisa.
Our next guest is also in studio, and before we get to him, I am curious, is everyone going back to the office? Is this basically a massive push that you're seeing kind of accelerate recently?
Well, I think there's that move. I think from an investment trading perspective, being on a trading floor, being together matters and matters a lot, right? You have the natural conversation, free flow exchange of ideas, and I think we're kind of reverting back to normal.
Well, let's have a free flow exchange of ideas with Colin Martin, fixed income strategist at Charles Schwab, joining us here on set. Have you noticed that as well, that people kind of are all coming back and it's kind of accelerated over the past few months?
I have noticed that just on my commute.
We're seeing the same in Amazon. Are you hearing about that, or are people excited to go back?
I've seen the headlines. I've heard it, but I think it is mixed. In that instance, I'd be a little surprised if that was my plan to work remotely. But I think people are okay going back in. I think the camaraderie, meeting people, exchanging ideas, I think that's really important. And I know that we're seeing that on our end.
So your boss can just know that he checked off all of those boxes. I'm kidding. I think a lot of people do agree, and it's just so wonderful to have you in the studio. Colin, I do want to start with this general sense of optimism, and frankly, this idea that we're getting a soft landing or something that looks much better than it did 2 months ago. Are you kind of buying into that belief?
Well, somewhat. We're still cautious, but every month and every week that passes, we're getting more data that comes in that kind of pushes back that arrival of the recession. Now, we have seen a lot of mixed data here and there. What we're seeing is a lot of the surveys are pointing to slower growth, whether it's all the regional Fed indices, whether it's the ISM manufacturing or services yesterday. But then when we look at the actual hard data, the labor market still appears tight, although albeit with some cracks. Inflation's still high, and spending is hanging in there. It's not going gangbusters right now, but it hasn't declined the way we would have expected. We do think we'll continue to see growth slow. If we look at GDP on a year-over-year basis of close to 1.5%, that will likely continue as the lagged effect and impact of all the Fed tightening works its way through the economy. But things are okay, and they haven't slowed down the way a lot of people really expected.
Colin, what do you think about inflation? So you're talking a lot about growth, but inflation is still hanging around. How is that driving your forecast on the rate side?
Well, it's still sticky. So if we relate the inflation outlook to what might happen to the Fed, it's really difficult to see how they cut anytime soon. That's a big discussion lately. The Fed funds futures market is still pricing in a cut. But with inflation, it's still 4 or 5%. That's still too high. We look at average hourly earnings, and it's moving in the right direction. But if you look at those monthly numbers of 0.3%, 0.4%, that's just too high. So if we look at that and add that all in with a strong non-farm payrolls number, things are still okay. We do think inflation will decline over time, but it's proving to be a little stickier than a lot of us thought.
Well, but I would ask both of you this, because I know both of you think that rate cuts are pretty much off the table for the rest of this year. I'm looking right now at Fed funds futures, and it actually shows an implied rate of about 5% at the end of this year. We've priced out a lot of the cuts that were priced in earlier, and markets haven't really gotten shaken. Has that surprised you, Greg?
It has. What's even more interesting is it's pricing in another hike and then a cut. Slightly, but not as extreme as it was a few weeks ago. Yeah, but I'm really taken back by this narrative that the Fed will cut and therefore risk assets will do better, right? It misses a central point as to why they would cut in the first place. And it goes back to the hurdle has to be extremely high for the Fed to cut. And they're just not going to cut because they feel like it. And that goes back to the inflation question that I asked.
Yeah, that's our exact view. The Fed's only going to cut if they need to. If inflation's still high, if they have to, they don't want to cut. We've heard that from Fed officials. They don't want to cut. I mean, that's stimulus, right? So if we look at what might happen if they cut, if that's good for risk assets, we're in the same camp as you. That's not a good thing because they're cutting because they need to stimulate the economy. That's not a good outcome.
But the fact that we have seen such resilience in credit markets suggests that this is an economy that can withstand rates that are higher for much longer than anybody previously expected. So at what point do you say, okay, let's say they keep rates where they are for a foreseeable future. Why can't you collect the coupons on riskier debt and just be happy with that, Colin?
I think the outlook is negative because of the point you made, higher for longer. Over the past 15 years or so, we haven't had this period of high rates. Anytime we've seen rates rise, they've come down, and it's allowed companies to kind of take advantage of that lower entry point. If you go back to 14, 15, with the oil price-induced spread rise, that came back down, and companies didn't need to lock in those high yields. We're at this point right now where high yields are 8%, 9%, 10%. They're probably going to stay there for a while. So it's not like they're going to have this exit point where they can go back in and refinance or even come to market with new debt. And then if we look at the leveraged loan market, those companies are getting hit right now. I mean, they're hit very hard by that rise in interest expense. They're seeing their annual interest expense double or even triple. That's going to hit their bottom line in a period when revenues are already in trouble.
I still think there's a chance, a really good chance, that rates will be higher for longer, and surprisingly so, right? If you script out this soft landing narrative, the Fed doesn't cut, the front end stays where it is, and then there's a normalization of the curve. And I think that's a real possibility, and in fact, that's what we're playing for. As far as pricing is concerned, as a fixed income investor, you're actually paid to be short the front end because you roll up. Right, so it's extremely advantageous to be short versus long, and I think that's telling you something, and it matters. So I think the bias is for higher rates, not lower rates, and it's predicated on the Fed not moving or normalization.
So are you saying that basically the whole curve could be at 4.5%, 5%?
Well, in a normal world, it should be, right? So, I mean, should we be persistently inverted, right? The inverted curve is telling you one or two things, or both, is that the Fed is cutting rates or we're entering a recession. So if we don't enter a recession and the Fed doesn't cut rates, then something has to normalize, and that normalization means higher rates, not lower rates.
Colin?
I think that's a good point. Now, I think we could see a normalization, but probably at a lower level. To get all yields up to that 5% area, it's not just a soft landing, it's everything's fine. The economy can really withstand the amount of rate cuts and such a high level of yields. But if we do get this soft landing that everyone's hoping for and wishing for, then maybe we see intermediate and long-term yields rise a little bit, and then over time the Fed cuts rates, but at a higher level than what the markets are projecting right now. So maybe not 3%, maybe 4%, something like that.
How much, and this is a viewer writes in, and I think it's a good point, how much is it that higher rates is actually stimulatory? That people are actually getting income and suddenly they can reinvest it in real things instead of having sort of the disinflationary and sort of, in some ways, outright deflationary idea of negative rates or zero rates.
Yeah. Well, I think we're seeing that right now. It is a good thing. I mean, when we talk to investors and the rates they're earning, these are the highest yields they've seen in a while. And I think one way to look at it is leverage in the system. And at least on the household level, it is lower than what we've seen in previous periods of excesses. And especially when we look at the mortgage market with people locking in such a low rate, maybe the rise in yields isn't impacting people as much as the Fed would have expected.
History is going to shine a very unfavorable light on zero and negative interest rate policy, right? It's had the opposite effect, as you alluded to. So I think higher rates is great for savers. It is stimulative. And like I said, the history books are going to look back and say, wow, that was not a great idea.
On Greg's point, I think I agree with that. And I think the whole idea of zero interest rates has kind of distorted what we've seen in the markets, where prior to 07, 08, 09, that zero wasn't a thing. And if the Fed does cut and only down to 2.5, 3.5, maybe intermediate and long-term yields won't necessarily fall as much as the markets are expecting.
We're running out of time, but all of this sounds very constructive and normalization after 2 decades of a pretty extraordinary policy, and yet I have to wonder, all of those excesses, we're not going to see any overhang from them. We're going to just chug along and everything's going to be fine. I mean, at what point do you start to say, actually, there will be some distress, whether it's commercial real estate or private credit?
Yeah, no, we are concerned. I don't want our outlook to come out too positive right now. We've been cautious on credit. Our focus has been on higher quality. And with yields where they are, this is our main thing that we're talking about with clients right now. If you can get 3.5%, 4%, 5% or more in high quality investments, why take that risk elsewhere in junk, bank loans, things like that? We think there'll be better opportunities down the road because we do see risks. When the Fed hikes to whatever the peak ends up being and holds for a while, key point being a while, we see negative impact there, and we do expect growth and inflation to slow.
Yeah, and the Darwinian process has just started, right? I mean, how many business models have been predicated off of zero interest rates, right? So you're seeing it in CRE, you'll see it in the corporate community, you'll see it on the consumer side. It just is taking more time than I think initially forecasted, but I do think it is occurring.
As Jim Reed over at Deutsche Bank said this morning, we're playing the waiting game, and that seems to be where we're at. Colin Martin of Charles Schwab, thank you. Greg Peters, unfortunately for you, but wonderful for us. You're sticking with us. Coming up, we've got Stephen Schork of the Schork Group on oil, which we were talking about earlier as a potential indicator of global growth. What does it mean that oil prices are still going lower even after the output cuts from Saudi Arabia? This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Jamie Dimon will be on Capitol Hill today. Bloomberg has learned the J.P. Morgan Chase CEO will meet privately with a group of moderate House Democrats to talk about banking in the U.S. economy. The closed-door lunch takes place as Dimon has been urged to enter the 2024 presidential race, despite his protests that he does not plan to run. Apple is set to extend its losses after the iPhone maker launched its much-anticipated mixed reality headset at an eye-popping price of $3,499. Now, while analysts were optimistic about the product and technology, they acknowledged that the price point was high and that it would limit the number of shipments in the near term. Meta's industry-leading headset sells for $1,000. The roaring rally in tech stocks still has further to go. That's according to Citigroup quantitative strategists who say the buzz around artificial intelligence and hopes for a pause in the Federal Reserve's rate hikes gives them an edge. They say they are positive on growth for June and see more tailwinds than headwinds. Consumer expectations for Eurozone inflation eased significantly in April, giving the European Central Bank more reason to end its run of interest rate hikes this summer. According to the monthly survey, expectations for the next 12 months fell to 4.1% from 5% in March, and for the 3 years ahead, they slid to 2.5% from 2.9%. Gun demand in the U.S. reaches the lowest level in 7 months. Unadjusted criminal background checks, they fell 11% in May compared to a 9% increase a year earlier. That's according to the FBI's National Instant Criminal Background Check System, which is a proxy for sales by the firearms industry. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I think Saudi Arabia sees itself now as a central bank of oil, and that it's, as the oil minister said, the petroleum minister, they would do anything to stabilize the market. The demand has not been what people thought. There's been disappointment over China, glumness about Europe, and uncertainty about the United States. And so they don't want to get in a situation where the price slides further and you have a tougher time climbing out of it.
That was Daniel Yergin, S&P Global Vice Chair, speaking with David Weston yesterday. Today, we are seeing oil prices lower yet again, even after the output cuts promised by Saudi Arabia, 1 million barrels per day. This, to me, is one of the more interesting aspects of today's markets. Otherwise, you're seeing basically a flat S&P. Actually, the NASDAQ has turned upward just a touch in pre-market trading. You can't keep a good tech down. The euro versus the dollar, 106.87. Yields a touch lower, basically range bound 3.67, and that crude level 2.5%. Kind of fascinating given what we heard yesterday out of Vienna. I am here, I'm so happy to say, with Greg Peters. John and Tom both are playing hooky, and we are so blessed to have you with us. I am curious, you were talking earlier about how this is really important to watch as a key indicator going forward.
Yeah, well, it's a great read into global economic growth, right? And so I think a big part of the reason why oil has softened is because the belief is that growth is coming off the boil, right? And so the demand is lower, and that's driving energy prices, and the cuts, maybe we're still out of balance with the cuts. And so I think it's a global growth insight story.
Well, especially given the fact that China seems to be concerned enough about growth that they're actually working on trying to stimulate and perhaps peripheral measures, whether it's encouraging state-owned banks to possibly drop some of the deposit rates, not mandating it yet. But right now, I am curious to hear some of the dynamics and what's sort of reflective of what's going on in China with Stephen Schork York, principal at the Short Group. I want to just start there. How much is lower oil prices really just simply a reflection, a readout on the Chinese economy?
Yeah, absolutely. To Greg's point, oil, as with natural gas, as with all energy, is your greatest leading economic indicator. So there's always this belief in the market when we see low oil prices or low commodity prices, somehow this is good for the consumer. No, you get low commodity prices because you have flagging economic demand. And this is the scenario we're at right now. Natural gas prices are depressed, well below $20 barrel oil equivalent, and oil now is failing to hold support around that $70 level. So clearly this is a sign, and we knew this going into the OPEC meeting. When we look at the market's term structure, whether in the domestic markets, the European markets, the Middle East, North African markets, we've seen a collapse in demand in the spot market, and we've seen this inversion in the term structure and this pricing. That is your clearest telltale that there is an imbalance between supply and demand. Now, OPEC took a really odd step. They really made a mistake here, and that is Saudi oil minister Abdulaziz bin Salman. He's been very vocal over the past month, warning speculators, bearish speculators, that they're going to ouch. Now, this is a very uncharacteristic move made by the very staid Saudis, and I think it really tipped their hand. In one of his statements, Salman said he's not a poker player. Well, that is clear because he really tipped his hand at this point, almost asking Wall Street to stop selling this market. So now it is a put up or shut up time for OPEC. They've been talking the talk, they've got to walk the walk, but the bigger concern now is what we're seeing in the spread markets is that economic demand led by China is a major concern, and we're seeing that reflected in price.
Stephen, I'm curious, how out of balance do you think the market currently is? So what do we need to see in your mind in terms of cuts in order to bring supply-demand back into balance?
Yeah, absolutely. Well, Greg, we're starting to see it here in North America. We're starting to see the rig counts both in Canada and in the United States take serious declines, really abnormal outside declines that we've seen over the past month. So this is our first telltale. But it's more important about OPEC. And there's always that push and pull between the International Energy Agency based in Paris and OPEC. IEA is always saying, OPEC, you're not putting enough barrels on the market. OPEC is saying, wait a minute, demand's not nearly as strong. I trust OPEC at this point. They're telling us 2 million barrel cut in April, this ongoing cut, discussions over the weekend. Clearly, we're probably out of balance, upwards of 2 million barrels, that chasm between supply and demand globally going forward into the summer season.
But Stephen, how much is this a short-term kind of confluence of events where you're going to see short-term weakness that only leads to higher prices later on because of a lack of investment by some of these oil majors?
Yeah, absolutely. The short-term weakness we're now seeing, Lisa. Now, what was interesting is the Saudi was saying, hey, Wall Street, stop selling. But going into that weekend, proprietary trading desks, traders that trade on their own firm's behalf, those bullish desks increased to the highest level since April 2020, and they took a bullish position that we haven't seen in the past 58 weeks. So they're getting stopped out right now, and that's a very short-term effect. But to your point, with the lack of investment going into hydrocarbons, the game we are playing on Wall Street, where it's a zero-sum game, I cannot put any dollars into a hydrocarbon because they all have to go into renewables. Okay, if that's the way you want to move, that's the way you want to invest, you have to be willing to pay the piper. And when we're not putting those dollars into advancing hydrocarbon, in addition to, we're of course going to lead to the greatest axiom in economics, that capital goes where it's welcome, stays where it is well treated, not being well treated, not welcomed in hydrocarbons, and therefore that could only lead to greater volatility, higher prices when we don't have sufficient supply infrastructure to get that oil from where it's being produced to where it's being consumed.
That said, Stephen, I do wonder how much this is starting to reverse in a pretty meaningful way. We already saw pushback from certain shareholders of big oil companies saying, okay, stop it with all the renewables, just invest in your core business. It seems like, despite some of the signs that global warming is continuing and that the climate is continuing to be an issue, people are sort of, okay, we've maybe overstated that. Is that what you felt as well?
Well, the climate, Lisa, has been changing for the last 5 billion years. So the question is, who is responsible? I'm going to say nature is responsible. Now, what we're seeing in the global economy is, hey, Germany, Europe's largest economy, is in recession. Why are they in recession? Because they went all in on renewables. They deemed natural gas to be on the wrong side, and they drove natural gas prices to the equivalent of $600 oil last year. Hence, they're in recession today. The United States is going that way with regard to its move to get away completely from hydrocarbons. So I think the writing's on the wall. Let's learn something from Germany. There's a balance here. We have to invest in renewables, but that cannot come. This cannot be a binary investment. You have to also indulge hydrocarbons, and I think slowly that pendulum is beginning to turn.
Stephen Schork of the Schork Group, thank you so much. You're nodding, Greg. Is this something that you keep hearing as well?
Yeah, no, I think the answer is both, right? And Europe is a great example. So Europe has to spend for near-term energy security and for renewables and green initiatives, right? So what you'll see and what you're seeing in Europe is they have to spend in ways that they didn't envision in the past.
How much are you willing to fund that as a debt investor?
Well, I think if you look back in kind of Europe fiscal history, there was too much austerity. So I think a little more, but it's a delicate balance. Europe continuing to raise rates, I think you'll see a switch, but I think it's too soon for that.
This has been really fun.
Thank
you for
Thanks
being
for
here.
me.
Do you want to become a TV host? You can join. You know, there's a couple empty seats.
I want to take Tom's job. Is
well,
what
I think,
do,
you know,
yeah.
no one's here. No one's watching. So, you know, Greg Peters of PGIM, thank you so much for being with us. It was truly fabulous having you right now in markets. Again, you just see that melt up, that desire to go upward with the NASDAQ in particular, just crossing into green briefly. The S&P is still a touch lower, but basically just still treading water near that 4,300 benchmark, 106.81 for the euro dollar. And you are seeing yields just a bit softer on the 10-year after we are in this quiet period ahead of next week's Fed meeting. Crude prices, we were just talking about that, lower by 2.2% despite the recent OPEC cuts. This is Bloomberg.
Welcome back.
So I notice in a couple of drugstores, even in my area, which is not the poorest area in Washington, D.C., it's a nice upscale sort of area. When I want to get razor blades, you have to go to the front of the place and ask somebody to unlock it. Why are you locking up razor blades and other things that I might want to buy?
Yes. So, you know, this is a national problem. And, you know, this isn't, you know, random theft. This is organized crime. And, you know, state legislation has put guidelines on, you know, how much you know, the theft that you can steal before you're convicted. So it's a $1,000 limit. But we have been partnering with other retailers and sharing our camera feed. I know some of our partners here from Walmart are here, but we are all part of an organization that's coming together that says if you've, you know, we can put our camera feed together and tell that that person has been in our store and their store, and the numbers are higher than 1,000. So we've been able to impact these theft rings most recently.
What are the things that are unlocking key the most? What are people trying to steal the most, other than razor blades? I guess?
You know, I will tell you, it started at razor blades because that's such a high ticket item, but, you know, it's a lot of cosmetics. But really what happens is that they take advantage of what I would call the elbow move, and they just come in and swipe a counter. And so it's just a matter of categories now.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it.
And features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in the store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
you really still believe in the 2024 recovery thesis, it's probably going to end up being a good buying opportunity.
I'm expecting the U.S. economy to, in the second half of the year, roll over into a recession.
You're seeing, I think, right now a real groundswell of hope that there's going to be a soft landing.
We're in a stage where good news is going to be good news for markets, and bad news, if we get it, will be bad news.
I think good news is back to being bad news.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good news will be good news, at least for this hour. Good morning. Welcome back from New York. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. I'm Lisa Abramowitz. John Farrow and Tom Keene both ditched me, but no, one person who did not is Neil Dutta of Renaissance Macro, who is joining us here for the entire...
As it's coming in, right?
Yes.
So it's been a very mixed bag, and I think that's why you're getting comments, well, good news is now good news. Good news is back to being bad news. I mean, I don't think that people really, I just think that there's a lot of confusion in the markets. And, that's okay.
Well, right now, a lot of people are saying that perhaps the Fed is less important. Maybe it's because it's the quiet periods. They've made themselves less important this week ahead of next week's Fed meeting. But it seems like they're kind of pricing out this idea that you could see a material increase in Fed funds rates going forward. We're kind of done. And now we have to actually see what the economy is doing in this sort of very confusing data dump that we keep getting.
No, I think that's right. I mean, I think the die is cast for the Fed to probably not do anything at the meeting that's upcoming. What they do going forward remains to be seen. You saw, for example, with the RBA overnight. I mean, they had paused for a couple of months and now they're hiking again. So we'll see. I mean, I tend to think that the economy is far more resilient, as you know, than is appreciated, and that's going to mean that the Fed's ultimately going to have to do more than what's priced.
Do you think that we're poised for an earnings recession?
I mean, we're poised for one. We don't have one. I mean, I think that I think primarily that what's actually driving the market is earnings expectations, which have generally been improving over the last few weeks. I mean, one of the things I feel like I've learned so far this year is that when people talk about breadth and so, I mean, these are just coping mechanisms for why you've been underperforming. I mean, that's honestly what I believe. I mean, at the end of the day, the stock market's a function of what? Three things, right? It's the risk premium, it's earnings, and it's rates. And rates are broadly unchanged, and year to date, and earnings are up, and that's why the market's up. Now, you can talk about, well, that's only for this company or that company. To me, it's irrelevant. I mean, my mother's really happy that Apple and Google and Microsoft are driving the gains in the market. I mean, it's like saying, like, oh my goodness, the stock market's being led by the companies that everybody owns.
All right.
Right?
Well,
So
this is all very positive, and somebody who's coming on next has a different view on what's to come, particularly with earnings revisions. Taking a look just quickly at markets, you are seeing the Nasdaq, basically treading water, but slightly up in pre-market trading for the second. Basically flat on the day as people reassess in a very quiet day of both Fed speak, none of them, as well as economic data, none of them of import. We are also seeing crude prices lower by about 2.2% to $70.59, traded on the NYMEX, even after some of the OPEC plus cuts. Our next guest has been talking about an earnings recession. He's also been talking about how you could see a soft landing, and yet you could also see companies really have to ratchet back what their profits are going to be. It's Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley. Wonderful to have you on. Let's just start first in your thoughts on what Neil was talking about earlier.
Well, look, I do think that we should acknowledge this is an unusual time in markets. And again, I think that opening clip showed, we have some of the highest core inflation since the 80s. We have the most inverted yield curve in the U.S. in 40 years, in Germany in 30 years. We have one of the lowest unemployment rates we've seen in the U.S. since the 1960s. So investors are dealing with some unusual data. Our view is that the economy is going to slow in the U.S. and Europe in the second half of the year, that the full effect of tightening has not yet been felt by the economy, but that tightening will continue to play out, and that even if you don't get a recession, the effect of slowing growth, especially the effect of slowing nominal GDP, is going to be bad for operating leverage, is going to put some pressure on earnings and mean that current expectations for earnings growth, we think, are still high for this year, which creates some near-term downside. Now, I think as you look further out, the picture looks a little bit better, but near-term, I think the market still has to get through a number of key challenges.
Andrew, you just put out a report talking about S&P earnings declining about 16% through the end of this year. What have been some of the responses that you've gotten? How have you explained why you see that, even though people have been revising upward some of those earnings expectations?
Yeah, so I think investors are skeptical of that sort of earnings move, which is understandable. It's a below consensus estimate, so the consensus is understandably higher. But also, I think you have investors who say, look, you've had economic data that's held up okay so far. You've had very good performance from some of the largest companies in the market, and so that is indicative of investors being more optimistic that earnings can be stronger going forward. And so I guess what we'd say to that is a couple of things. First, we do run kind of forward earnings indicators, forward earnings estimates, and those estimates, those models have been pretty good at predicting the events so far, and those models are saying that there's going to be more downside to consensus than what the consensus expects. I think if you look at some of those larger cap names that have been outperforming, their actual earnings growth has not been particularly strong. And even if for the market overall, earnings growth is rapidly approaching kind of flat year over year. So this is a market that even in a still a pretty strong nominal GDP environment is struggling to grow overall earnings. And we think that will get more difficult as you move ahead, as the market confronts the lagged effect of rate hikes and the lagged effect of some further tightening in bank credit conditions.
So Andrew, hi, this is Neil. Can you explain exactly how the long and variable lags work? I mean, because we've been hearing this argument now for, really since last year. And, I would expect to see significant slowing in credit areas of the credit-sensitive areas of the economy. But that's not what we're seeing. I mean, housing, autos, I mean, they look like they've been doing a little bit better. So can you explain, how that will actually work when it's been, several quarters now that they've been hiking and some of these credit-sensitive areas are actually picking up?
Yeah, so look, I think that's the challenge. The challenge with long and variable lags is that they're long and they're variable. And so if we think about our estimates for that, we think that rate hikes, you feel the full effect, maybe with a 12-month lag, which means that if we had rate hikes starting at the beginning of last year, you are only now starting to feel the full effect of those rate hikes in the U.S. and Europe. So we've not yet felt the full effect. The full effect is still to come. Moreover, if we think about the real policy rate, right, the interest rate relative to inflation, that is still going through some of its largest increases over the next several months as inflation finally falls and we think the Fed and the ECB keep rates high. So I think the first element is we haven't yet seen enough time to see the full effect of those rate hikes play through the economy, and we actually haven't seen the full effect of rates relative to inflation. Now, I think as it relates to the more credit-sensitive sectors of the economy, again, I think that's pretty fascinating because, again, as we've talked about at the opening, the equity market overall is very strong. The most credit-sensitive parts of the market, say the Russell 2000, small caps, more cyclical stocks, have really struggled. Commercial real estate, credit-sensitive, has really struggled. So I think we are starting to see some of the impact of that tighter policy play out. It hasn't played out at the overall market cap level, but I think it's playing out below the surface, and I think we still have some of that to come, which is a reason why we think growth decelerates further into the second half of the year.
Andrew, just quickly, how does this idea of a deceleration in earnings growth pair with a soft landing?
So I think they're actually quite compatible. Again, if we think about the types of forecasts that we're seeing, we saw a market and earnings really outperform the economy over the last 18 months. And I think one way of thinking about our estimates is that in the U.S., earnings in the market underperform the economy somewhat as you go forward. And especially because I think we think earnings are much more geared and much more linked to nominal GDP growth, which is decelerating sharply, maybe more so than real growth. Another part of this that's important is the labor market. I think if you have a soft landing, I think you're inherently talking about fewer job losses than you'd have in a recession. Well, fewer job losses is great for workers, but it might be more of a challenge for margins if the top line is slowing and costs aren't being pulled back in the same way.
Andrew Sheets of Morgan Stanley, thank you so much. Neil, what's your thought? I mean, honestly, this is something that people are talking about, that you're going to get some sort of pullback and that you are seeing some of the sort of deceleration, particularly in the interest rate sensitive areas of commercial real estate, banks, others.
Sure. I mean, well, I think a couple of things. I think number one, you know, it's been a year, right? I mean, he said 12 months. It's been about 12 months. And what have we seen? Housing is accelerating. U.S. housing is accelerating. New home sales are surging, which means those are signed contract, Lisa. Signed contract. So that means that the home is sold, and that means that construction spending picks up. Now, with respect to long and variable lags, I mean, there are long and variable lags with fiscal policy also. I mean, the government, I think it cannot, you have to state this, the government did an unprecedented amount of stuff during the pandemic, okay? And when you give people money, that becomes their income. They go out and spend it. That becomes somebody else's income. I mean, you're still talking about state and local governments that are still sitting on pandemic relief money. You still have, I think I just saw Connecticut announce like a pretty significant income tax cut. And then you have, it's being drawn down, but you still have a decent pile of excess savings that's out there. So there are long and variable lags with fiscal policy as well, which is blunting some of the monetary policy effects.
And perhaps people have underestimated some of those long and variable lags pretty substantially, including myself, frankly, coming into this. I'll be honest, I didn't understand and appreciate just how significant that pile of cash, which we could talk about later. Right now, we are seeing some softness, although not necessarily in bonds. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The suspension of the federal debt ceiling is presenting a fresh challenge for U.S. banks. Lenders are struggling to hold on to deposits as customers opt for higher yielding alternatives. Now, money market mutual fund assets have ballooned to an all-time high. They've been quicker than banks to pass along to customers the higher interest rates supported by the Federal Reserve's policy actions over the past year. Ukraine says Russian forces have blown up a giant dam in the country's south. The blast has unleashed a deluge of water, putting 10 villages and parts of Kherson at risk of flooding. Residents are being told to prepare to evacuate. President Volodymyr Zelensky summoned an urgent meeting of Ukraine's National Security and Defense Council to discuss the attack. Morgan Stanley is planning to move to a new office in Singapore as it looks to expand its presence in Asia. Bloomberg has learned the company is in advanced talks to take over 5 floors of towers currently under construction. A boom in private banking, family offices, and other financial services during the pandemic has boosted demand for swanky offices in Singapore's business district. In China, hearings began today in a Tesla lawsuit against a protester who climbed on a car at the 2021 Shanghai Auto Show and shouted that a brake failure had almost killed her family. Now, the incident fueled online criticism of Tesla in China. Tesla denied the claim and filed a case against the protester, seeking $700,000 in damages. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
hours for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg The Open with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
Mainland China has fully recovered, but again, driven largely by domestic Chinese travel. International airline seats into mainland China are only about 40% recovered to where they were pre-pandemic. But the balance of Asia-Pacific, particularly markets like Japan, Thailand, are booming right now.
That was Tony Capuano, Marriott International President and CEO yesterday. China mainland has recovered fully. That is what he had to say, even though you do see right now an effort to stimulate that economy. In markets, you are seeing pretty much flat, not a lot of action, a quiet period for the Fed, as well as, of course, a relatively quiet period for economic data ahead of next week, which is pretty massive. Crude down more than 2%. A lot of people thinking this is on the heels of what we're seeing over in China. Tom and John both off today. Very happy to say we've got Neil Dutta of Renaissance Macro here alongside me for the hour, and really focused on China. I don't know how much that people can really account for it in their models, but how much do you think that's really the story behind oil that's really been driving it?
Well, it's hard to know because in some respects, I mean, demand has been holding up. If you look at consumer demand, I mean, right? I mean, at least, people are going to work more, traveling more, jet fuel demand is certainly higher, right? So I think the industrial side of China has been a disappointment, and I think that speaks to broader global manufacturing conditions, which have been sluggish. But at the same time, I think, at least as far as the U.S. is concerned, there's probably some room for improvement. Inventories are low everywhere, and at some point, if consumer demand is basically just holding steady, you're going to have to rebuild inventories eventually, right? And so what's interesting about what's going on in China is, as weak as it is, just look in China's neighborhood, right? There's a lot of strength there, right? Japan is on fire. India is on fire. I mean, it's like the gravity model of trade. So even though China is very weak, you have signs of improvement in other areas of the Asian Asia complex.
I'm so glad you mentioned that. Damian Sassower dropped by of Bloomberg Intelligence. So happy to have you, as always, covering all things emerging markets from the credit sphere here at Bloomberg. And I'm curious, though, from that perspective, you are seeing that dynamism in other areas. And then add to that this idea that perhaps we'll get more stimulus from the Chinese Communist Party, as indicated overnight. How much are you looking at something that could surprise to the upside with respect to all of this activity?
Well, I think for every Japan, I'll show you Taiwan and South Korea in Asia. So, I think it's a tale of two stories. And, I think it's an eye of the beholder story because, rightly point out, I think the disappointing thing about China right now is the industrial sector. It's not playing ball the way it has in years past. But I look at the household sector, and my God, is it weak? And my God, is the private demand weak? And I think what we're seeing overnight in terms of the PBOC gently nudging, the big three banks to kind of ease deposit, right? Ease deposit rates is really a function of the fact that they just don't want to extend credit. And we're going to see credit data at the end of this week. It's going to be pretty dismal, I believe. I mean, household borrowing is basically non-existent. And I even think corporate bond issuance, just given market sentiment, is going to be relatively weak as well. So, despite it all, how much I think Neil Dunn is hitting on something that's important here, just how much are policy cut's going to really impact the Chinese economy? I mean, in a world where the rest of the world is hiking rates, what kind of impact's that really going to have on household balance?
So you're not buying this. You're not seeing this as sort of a risk-on moment, right?
Not from a China perspective, no.
What about what we saw overnight from the Reserve Bank of Australia? Because it's the opposite trend, exactly to what Neil was talking about, this idea that you are seeing a reacceleration in certain economies for both the good and the bad, meaning that it actually is a reacceleration of inflation that Australia is looking to fight.
Yeah, well, I mean, again, you show me Australia, I'll show you India. You show me, or Peru even. Or last week, if you look at the central bank minutes out of Chile and Mexico, who have been, or high yielders who have been, first movers in terms of hiking rates, they're going to be on hold for far longer, and they've indicated as such. So, I think in this type of an environment, with the VIX now below 15, it's very, very difficult to see when something's going to drop. I mean, everyone's thinking something's going to break here. Maybe it won't, maybe it will. I don't think you can manage a portfolio kind of with that in mind. But yeah, I mean, I think you have to assume that this is an environment with inflation low and interest rates high. I mean, the carry trade is working really, really, really well in emerging markets. I expect that to probably continue through the summer months, so long as something doesn't break.
Does the market need China? Like the broader global market? I mean, because, I remember like in the years following the financial crisis, right? I mean, the China hard landing scenario was basically this perennial fear that every investor had. And a lot of final assembly has already leaked out of China, right, to Vietnam. And so what if China's not working? I mean, to me, it's a lot of it is contained within China, right? I mean, you talk about CRE here in the U.S. I mean, their entire property sector has been a disaster, but we've been talking about that for how many years now? Yeah. So I wonder, I mean, so how do you feel about the China spillover
into the rest of the world?
Yes.
Yeah, I think that mechanism is definitely not as strong as it once was. It's simply because you're seeing an economy that's transitioning from one that's export-oriented to one that's inward-looking and more consumption-oriented, right? So to your point, China hasn't been working from a global sort of contagion for years now because they haven't been really stimulating on the export side. They're stimulating domestically. And again, the private sector in China is just not cooperating. I mean, sentiment is so poor, they're so weak. And if you look at local debt levels, I think Goldman had a piece out last week, $22 trillion of debt outstanding, including off-balance sheet items in China. It's a massive number. We can't even quantify it. But, if you just kind of like look beneath the surface, you look at local government finance vehicles, 86% of their tax revenues have to be funded from subsidies by Beijing now. That's up from 66% in 2015. That's a massive amount of subsidies because the municipals and the local, because basically there are no land sales in China anymore because the housing market has dried up.
Okay, but maybe I get your point that perhaps its influence isn't as great as it once was. There still are some pretty big nodes of contagion here, even in the likes of Apple, right? I mean, if they really slow down or have a serious problem and can't manufacture some of the parts or something like that, there could be a real issue. How much, though, is it just the absence of that growth engine? How much is that really what's going to drive the contagion? Because China's going to normalize at something well below what it has in the past.
Or is it changing? Is the growth engine no longer going to be China? Is it going to be Europe? Is it going to be the U.S.? I mean, again, it's just a matter of where's the growth going to come from.
A lot of these companies, again, though, Lisa, I mean, you mentioned Apple. They have been leaking final assembly out of China. I mean, they're moving into India, other parts of Asia. So it's, it's important to remember that a lot of this has been, going out of China for a while now. So they're not as, they're important to the global supply chain, no doubt about that, but they're not as important. So it's really, for me, it's about what's happening at the margin.
Do you think that the trade data where we're showing record amounts of trade with China and the U.S., right? Do you think that is perhaps overstating the relationship because of some very specific distortions? Because basically what you're saying is that the U.S. and China have been decoupling for a while, and a lot of people keep saying that. Is that your sense?
Well, I think it's certain pockets of it. And I think one thing we are kind of not talking about, which is an important point, is the second wave of COVID and how that's hit China. I mean, Shanghai's still in lockdown. And, you're seeing restrictions in a lot of urban areas around China. And it's tough to quantify that. But if you do want to talk about rest of Asia and the impact, you look at, exports out of Taiwan, exports out of South Korea. Yeah, they may be bottoming, but they're just not really ticking up to the extent you once was. Now, that's not a function of China. It's more a function of demand from the U.S. and Europe and the rest of the world that's really driving semiconductor demand and all that kind of stuff. I mean, again, China's just an assembler. So I think China's role in all this is still quite large. There's no getting around it. But its impact, just in terms of, at the margin, is it going to be the driver of incremental risk? I don't know if it will be anymore.
Neil, you think that's the same?
Well, like I say, China is important. right? There's no getting around that. I mean, I don't have a very strong view on China, but I do think I think it was great that you brought up the China the COVID issue. I mean, I think that may sort of hurt growth at the margin. But as I say, I mean, companies have been moving away from China for several years now. And this is going to be a secular theme that you're going to have to deal with probably for the rest of your investing life, because it's a bipartisan phenomenon, right? I mean, everyone wants to be hawkish on China. So you can expect more of the same in terms of trying to decouple the U.S. manufacturing base. Look at what's going on with CHIPS Act and things like that.
Neil Dutta, you're sticking with us. Damian Sassower, thank you so much. As always, wonderful to get your insights. Coming up, we'll have more, particularly with this economic sphere, the uncertainty going forward. Cara Gadana joining, Chief U.S. Economist at BNP Paribas. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg Surveillance on Bloomberg Television and Radio. Tom and John both off today. Very happy to have Neil Dutta alongside me from Renaissance Macro. A pretty quiet week when it comes to economic data as well as Fed speak, but going into an incredibly important week when it comes to the Federal Reserve. No drama over in equities, a bit softer in the S&P, down about 0.1%, 42.75. The euro dollar basically 106.7. You can see a sort of softening in the euro, strengthening in the dollar as the session grows older, and crude have been focusing on all morning, down 2.2% despite the OPEC plus cuts unilaterally led by Saudi Arabia. There is this question about how much we have to hinge on the Fed and whether the Fed matters less. It is nice to have the Fed matter less, and now to actually think about what the economy is telling us. And Neil, before we go to our next guest, who is a great friend of the show, I am wondering how much there's been a psychological shift in workers, that basically there has been some kind of pandemic-driven malaise that has driven some of the confusion in the data.
That's hard to know, but I think with respect to workers, this is the first time, I think, for most of us that we've actually had to deal with a structurally tight labor market. And for the people that are working, they probably have more labor power, than they have in quite a long time. So even though we've sort of noticed that, okay, the quits rate is declining and things like that, I mean, there's signs of normalization in the labor market, they're still at levels that they never were before the pandemic. So I think that, to me, is an interesting structural sort of theme that's unfolding, which is, what if we just have a structurally tight labor market? And because employers have had so much difficulty finding people during the pandemic, that's increasing their reluctance, I think, to fire them, even in the face of, somewhat sluggish growth, because they're worried about what it may take to bring them back.
This is one reason why perhaps people don't see the Fed hiking rates at next week's meeting, but the week after, I don't know. The Fed in its quiet period right now. Cara Cardano of BNP Paribas weighed in on the path forward, writing, quote, "We continue to anticipate a pause at the June meeting. Further, we expect deteriorating economic conditions to obviate the need for additional restriction later this year. However, we cannot rule out the prospect that upside surprises in economic data might spur Fed officials to re-engage with further rate hikes." Carl joins us now. And Carl, I do wonder how much people are perhaps overstating the need for more rate hikes if you do see such a deceleration in growth, or whether we're understating it based on the fact that you do see this structurally tighter labor market.
Well, Lisa, our view, maybe that wasn't the most opportune quote to pull. Our view is actually that they will have another hike at the July meeting, so that may have been from a pre-non-farm payrolls report note. We did think maybe the June rate hike was the final hike of the cycle, but in light of the resilience we saw in that labor data, not only the headline print that far surpassed even the most optimistic forecast among the consensus pool, significant upward revisions to the prior 2 months. We think that we are getting close to the end point, but we're not quite there yet. So Jerome Powell and company have sold the idea of the skip, so we shouldn't call it a pause, we should call it a skip. I think by the time July rolls around, I mean, we are in a decelerating trend, whether we're looking at tax collections or GDP growth. There is a deceleration taking place. I think by the time the July meeting rolls around and we look at that Q2 senior lending officer survey from the Fed, the policymakers will be more confident that they have the right prescription in place, and then we can evolve from hiking to holding longer is the new hiking. And I think that will be kind of the mantra going into the back half of the year.
So what's the point of skipping? I mean, if they're going to go in July.
The point of skipping is to take in some new information, and you could call it a pause, but I don't think you can sell it to the hawks on the committee if you call it a pause.
Don't you think it would have made more sense for them to do it in May?
With a very strong tightening bias in place. Could have made more sense to do it then, right? Hindsight is 2020. Had we not seen that non-farm payrolls print last Friday, I think there would have been a more compelling case for a pause, given what we're seeing in the ISM surveys, especially the manufacturing survey. They need to see what is happening in terms of credit conditions more broadly in the economy, and by skipping June, then they'll have the benefit of looking at the Q2 data ahead of the July meeting.
So I guess the thing, I mean, if you look at the Fed's forecasts, right? I mean, they have what, like 0.4, 0.5% Q4.
I think those forecasts will have to change in the next update round.
So and it could be pretty dramatic. I mean, the IMF has their 2023 estimate like twice that, and the unemployment rate, they have it at 4.6. I mean, what do you think the odds are that they go more than one more time this year? Because in September, right, they will come. I mean, they'll have another cut at the projections. And what do you think the unemployment rate?
If I thought it was higher odds, then that would be my baseline. I don't think by the time we get to the September meeting that they'll see the need for additional rate increases. And what fundamentally is happening here, if we look across the broad history of monetary policy in the U.S., when you push the Fed funds rate above nominal GDP growth, things tend to start unwinding and decelerating. And that's exactly where we will be at mid-year, right? The Fed's above 5%, going higher at the July meeting, presumably, assuming the data hold up, and nominal GDP is crossing below 5%. When that has happened, historically, that has led into either a deceleration or an outright recession. And so for that reason, I don't think they'll have to re-engage. But again, this this very unique labor market environment we're in with labor hoarding and resistance to let go of workers, could change that dynamic.
Why hasn't anything broken? I mean, some people said that Silicon Valley Bank, et cetera. Some people point to the mortgage market. That's already recovering. You said it's re-accelerating. But are you surprised that this economy has held in as well as it has and seems to be continuing to go along?
I think that we shouldn't have the mindset that something has to break. We just have to see downshifting and possibly shifting into contraction and interest-sensitive categories. So if that's your definition of break, then yes, it has to break, but we don't have to blow things up per se. We don't need bank failures and that sort of thing. It's surprising to me that we haven't seen more pullback in sectors like housing and whatnot, where we're still generating pretty impressive job gains. It looked prior to the last jobs report like we were seeing job creation in fewer and fewer sectors. That was not true in last Friday's jobs report, where we saw really a broad diffusion. You saw losses in the tech and information sector, and you saw losses in the manufacturing sector, but everywhere else was pretty robust job gains. So I guess the most surprising thing to me is just the real resilience we're seeing in the housing sector. But again, it may be too soon to tell, because we are now finally moving into national home price declines, and that could change the flavor of things going forward. It certainly could impact banks' willingness to extend credit in those sectors.
Well, are we seeing national home price declines, Carl? I mean, if you look at the latest Case-Shiller data, there's been an improvement. That data's lagged. If you look at some of the weekly data that come from Redfin, there's been a pickup in home prices. Inventories are still low.
Sure. I think we should be careful not to, maybe get washed up in seasonality effects in the housing sector. So we really have to pay attention to that 12-month rate of change. And it's been decelerating. And I think we're due for a spell where it could actually fall deeper into contraction. It's a housing affordability story, and if you believe the unemployment rate is going to start moving higher, as it did last Friday, and as I suspect it will through year end, then that is a big factor into the affordability story. You're not getting any relief on interest rates. You're seeing household income decelerating, right? And so to kind of even out in the housing affordability equation, then you have to have some relief on the price front.
So I'll just, if there are long and variable lags to policy, why are home building stocks on the S&P 500 at 52-week highs?
I'm not going to make a call on stock prices.
I'm not asking you to make a call. I'm just saying, why do you think new home sales are? I was talking to my buddy.
They will have to reconcile with fundamentals eventually, and so if there's a reacceleration, then that will be justified. But the stock market.
Are you surprised that new home sales are at a one-year high?
You mean home builder stocks?
No, new home sales. New home sales, as you know, are at a one-year high.
I'm a little bit surprised, but again, that factors into kind of the resilience we're seeing in the labor market, right? The income creation is still holding up, and so it is these long and variable lags, right? If we think of, kind of conventionally a 12-month lag on monetary policy, 12 months ago we had a 1% Fed funds rate, right? So there's a lot of monetary tightening kind of working its way through the python, which I think will show up more forcefully going forward, and that's going to depress activity further. It will weigh on prices, and and have consequences for the sector.
One reason why it's been so confusing is because you do have the manufacturing sectors, the interest rate sectors that were moving on one hand, and then you had the services sector moving on the other hand. Now, especially after the ISMs yesterday, it seems like you have a decline with respect to the services sector, at least from relative to where people expected. But you have a reacceleration in certain areas, or at least in pockets in manufacturing. How long can that keep inflation higher for a much longer period of time than people previously expected?
Well, inflation is persistent, sticky, and higher than expected, and that's been the story for much of this cycle, which means the Fed has to have a more forceful policy response to deal with that. Until we see wage pressures coming down in a more material fashion, then I would be very surprised to see inflation pressures coming down while wage pressures are still sticky. If you look at kind of where we need to be, you need to see whether, pick your metric, whether it's ECI, average hourly earnings, whatnot, they have to be closer to kind of 3% than the 4 and 5% readings we've been seeing if we're going to get back to 2% inflation.
So you guys might be disagreeing about housing and about what's going on with respect to the acceleration or not, but you seem to agree on the idea that inflation is stickier and that the Fed is going to have to do more. I mean, from that perspective, how does it make a difference in terms of whether things are accelerating or not? There seems to be resilience. Do you agree that there needs to be some sort of response that goes beyond the market expectation for the Fed right now?
Yeah, that may mean that they hike again, or it may mean they just hold policy steady. I mean, a lot of the reason why, right, because if they're holding policy steady, that's a de facto tightening of policy because the markets are pricing in cuts. Now, I think a lot of these rate cut bets are really just tail risk bets. I mean, people are, sort of latching onto this idea that a recession is imminent, and that's why the bond market's priced the way it's
or
priced.
that there could be a systemic bank issue. Right.
Yeah, but I think as you get closer to each meeting, those expectations will come undone and rates will go up. I mean, it's not unusual for the bond market. It has a habit of pricing in tightening cycles long before they start. Once the tightening cycle does start, bonds have a habit of pricing in the end of the tightening cycle before it actually ends, and that just creates lots of trading opportunities in the front end of the curve. So, to me, it's not that unusual.
Kara Gadana of BNP Paribas, thank you so much for coming in.
Pleasure.
Really appreciate it. And this has been a perennial debate about where we are in an economy that is anything but clear. The fog, as some might say it. Coming up, we're going to be speaking about some breaking news in the crypto space, as well as taking a look and catching up with John Farrow, who is in the PIMCO headquarters at Newport Beach. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Jamie Dimon will be on Capitol Hill today. Bloomberg has learned the J.P. Morgan Chase CEO will meet privately with a group of moderate House Democrats to talk about banking in the U.S. economy. The closed-door lunch takes place as Dimon has been urged to enter the 2024 presidential race, despite his protest that he does not plan to run. Higher energy costs are reverberating through Europe's economies and are keeping inflation high. That today from European Central Bank Governing Council member Klaus Knot. The Dutch central bank governor spoke in Luxembourg today, a week before the ECB is widely anticipated to raise interest rates further before another projected increase in July. In France, unions are holding a fresh day of strikes against Emmanuel Macron's pension reform. It's the first nationwide protest in more than a month, and it will test whether the president has succeeded in getting much of the country to move on from the politically damaging fight. Macron has faced down months of protests and strikes. He angered many when he enacted the legislation without a full vote in Parliament. The Securities and Exchange Commission is suing Coinbase in federal court in New York. The federal claims the largest U.S. crypto platform broke its rules for years. Coinbase is accused of allowing users to trade numerous crypto tokens that were actually unregistered securities. Bloomberg reported in July that Coinbase was under SEC investigation. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
The Fed is behind us. Maybe they hike once more, maybe they hike twice more, but that's it, right? We're kind of near the end of this, so we can start looking at earnings, where the economy's really headed. And I think we're in a stage where good news is going to be good news for markets, and bad news, if we get it, will be bad news.
That was Peter Scheer, Academy Securities head of macro strategy yesterday. Good news will be good news, bad news will be bad news. We heard from Michael Gapin over at Bank of America. Maybe good news is still bad news. Neil Dutta loves it all. He's alongside me for this hour. And he is because my co-anchors are off today, except that Jonathan Ferro is not off. He is in Newport Beach, California, at the PIMCO offices. He joins us now. Hey, what's going on?
Bramo, good to see you. Don't feel sorry for me. A beautiful Newport Beach, California.
I'm not.
As for TK, TK's come with me. He's working the cameras this morning. So
right.
If anything goes wrong on that front, you know whose fault that is. I think the lineup this morning, Lisa, speaks for itself. Just absolutely phenomenal. Some of the brightest, best people here at PIMCO and beyond. In about 10 or 15 minutes, we'll catch up with Dan Iverson, the CIO. We'll round out the hour, close out the hour with Manny Roman, the CEO. If you want some Fed speak, we'll catch up with the former Fed Vice Chair, Richard Clarida, at around about 9:30 Eastern Time on U.S. policy, Libby Cantrell, on what that means for the U.S. economy, Tiffany Wilding, on credit, Mark Kiesel, Sonali Peer. Take your pick, Bramo. If there is a theme that you want a better understanding of, not just for the next couple of quarters, the next 5 years, when this secular outlook drops in about 13 minutes' time, we'll bring you some of that clarity.
I cannot wait. And just for the record, John, I was not feeling sorry for you. I really wasn't giving you any sympathy whatsoever over Newport Beach, just, to make sure that you understand. But tell Tom that he needs to really make sure to keep it steady and not move too much with the camera.
TK's going to step up. Look, there are some big issues elsewhere. My beloved AC Milan, there are some reports they fired Paolo Maldini. So there are some issues that TK and I need to talk about tomorrow. Plus Spurs, his beloved Tots, reportedly have a new manager as well. So there's some news, Bramo, beyond PIMCO and all this good, fascinating stuff. We can talk about sport another time.
So I hear. Jonathan Ferro, thank you so much. Can't wait until your interviews in the next hour. With me for the hour is Neil Dutta of Renaissance Macro. We are going to parse through some of the issues that we were talking about earlier. But before we get there, we do have some breaking news that we want to get through about Coinbase getting sued by the SEC. And just a quick recap of what's going on there and why it matters. Emily Nicole joining us now, Bloomberg crypto blogger. Emily, what is going on?
So we kind of had a feeling this was coming, and now it's finally here. Coinbase told us back earlier this year that it expected to receive a lawsuit from the SEC. It received what's known as a Wells notice, an intention to sue. That has now landed today. The SEC has said that Coinbase has been selling unregistered securities because it also offers, several different services under its wing. It's an exchange, it's a clearinghouse, it's a broker, and all of those are unregistered activities with the SEC.
Bloomberg's Emily Nicole, thank you so much. We'll keep track of this as the day goes on. Neil, how much do you pay attention to the cryptosphere? Okay, why not? Because there's so many people who said it was a macro kind of driver in the sense that it was sort of risk appetite in the frothy areas. No longer?
I mean, there was a time when Bitcoin traded basically like the NASDAQ 100. Now that the NASDAQ 100's rallying quite sharply and Bitcoin hasn't really been, I mean, I guess that narrative can be put back on the shelf. You know, look, I don't pay attention to crypto. I'm more of an equity and bond market person.
All right, so let's talk about equities. You were talking earlier about the home builder stocks and how they were surging and they were 52-week highs. And you think that a lot of people are ignoring this conveniently. Why? Why do you think this is such an important area?
Well, the linchpin of the bearish economic call is long and variable lags, sort of, you know, putting Milton Friedman up there as your crutch. But if you were to tell someone that mortgage rates would be close to 7%, would new home sales be accelerating in that environment? I don't think most people would say, oh yeah, that's going to happen. Or home building stocks will be at 52-week highs. So there's something clearly going on. And I think obviously part of what's going on is there's no inventory in the resale market. So to the extent that we have a strong demographic patch in the country and people are demanding homes, they're going to be at the margin pushed into the new housing market. You know, typically, you know, the new housing market represents maybe 10, 15% of the inventory that's out there. Now it's like twice that, 30%. So at the margin, people are going into new homes. And the builders, they have the ability to buy people down. So, you know, a person that's buying a new house, they're not paying 7% on their mortgage. They're probably paying something substantially less than that. And that's making the math work for a lot more people.
Let's pick up on that. That's important because right now we are seeing these 7% mortgage rates put out there and people say, why isn't that slowing things down more? You were saying almost nobody's paying that, whether they're getting sort of a rollover of some of the old mortgages that are refinanced for new people, kind of what happened back in the 1980s, or whether you have this kind of thing where if you have a company that's making enough money from lower lumber costs, from lower input costs elsewhere, they can just fork over the cash to give a cheaper loan to a potential homeowner.
The people in America that own homes, they are not in the business of selling homes. Home builders are in the business of actually selling homes, and they'll figure out innovative ways to do that. And one of the things that we're finding is just sequentially, things are getting better. I was talking to my friend Rick Palacios, who's a housing analyst over at Consulting, and he's basically telling us, look, and April was a solid month. May is a solid month. New home sales represent signed contracts, right? So that's why they've long been considered a leading indicator for housing market activity and the broader economy. So what you can expect to see going forward, first it's going to be home sales, then it's going to be housing starts, and I'd expect to see things like lumber prices start to pick up. I mean, there is an underpinning for demand, and that's going to push up residential investment, which is, again, I mean, that was a linchpin of the bearish call last year.
So just to push back a little bit, this has been sort of one of the arguments that you have had less interest rate sensitivity because all of the higher costs are not bearing their way through the market. You're not actually seeing a lot of companies pay these higher borrowing costs simply because they refinanced as much as they did during the pandemic. You're not seeing homeowners pay these higher mortgage rates because of some of these financial engineering of different companies, as well as just the fact that people have locked in mortgage rates. At what point does that time run out? Do people start having to pay the price that the sticker seems to suggest of what the yields are and what the interest cost is?
Well, in the housing market, it's going to take a long time, Lisa, because, you know, the 30-year, I mean, the Fed has probably done more to break the Canadian and the UK housing market than they have the US housing market. Because in those countries, there is no such thing as a 30-year fixed rate mortgage. They don't have that product. If you look at adjustable rate mortgages in the US, in 04, 05, that was like 40% of the mortgage debt. Now it's like less than 10%. So that's why I say, I mean, this long and variable lag story, I mean, and in the short run, it increases the probability that the Fed will have to get closer still to 6% than not.
Because there is this sort of interest rate insensitivity of the economy in this way that is leading to some resilience.
To me, it's more of an income cycle than a credit cycle. I think that's what people miss, right? I mean, remember, credit has been tightening for several quarters now. If people talk about the senior loan officer, they finally discovered the senior loan officer survey, a couple
months ago.
And that had been showing tightening credit for the last 4 or 5 quarters. Bank lending, the H8 data, another data point that no one was ever paying attention to before, like 3 weeks ago, that's been showing slowing credit for a while, particularly for C&I. During that time, the U.S. economy has generally, I mean, just pull up the Bloomberg Economic Surprise Index. During that time, what's been going on? The data's been surprising to the upside. So I think people are conflating, to some extent, a credit cycle for an income cycle. And incomes are still running at a relatively robust pace. You talk about disinflation. What do you think that's going to mean? People are paying less for groceries, less for energy. That's going to boost disposable income.
But aren't new home sales well below pre-pandemic norms?
Up is up. I mean, so, I mean, no, I mean, actually in May, we're basically where we were in 2019, which was a very good year for the new housing market. So no, I reject the premise of that.
Okay. I think that this is something that a lot of people are increasingly kind of flirting with. If the market is not, if the economy is not responding enough, does the Fed have to go further? And will that cause some sort of steeper decline? We only have about 30 seconds. Do you think that this means that the recession down the line will be more significant because the Fed will have to go to 6% or beyond?
I mean, I think if you don't get below trend growth now, you may have to get, somewhat slower growth later. And it's pretty clear that we don't have below trend growth at the moment.
This has been fun. Neil Dutta, thank you for being here.
Have me on anytime.
You're like, I can bring.
You want me to put a bow tie on next time? I'm happy to.
What's on your tie right now?
We have dolphins on there.
You have dolphins, not Santa Claus. What was it last time?
It was a holiday theme.
It was a holiday theme. Neil Dutta of Renaissance Macro, thank you so much. Coming up, don't miss it. We have Jonathan Farrow broadcasting from PIMCO's headquarters, also at 10:30 a.m. Eastern. We've got SEC Chair Gary Gensler. He can weigh in. He's much more focused on crypto than I'm sure we were just then, but talking about the SEC suit against the crypto sphere.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Live from PIMCO HQ, good morning from a beautiful Newport Beach, California. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from Newport Beach, coming up, PIMCO unveiling its secular outlook. The CIO, Dan Iverson, just moments away, with CEO Manny Roman closing out the hour. On the U.S. economy and U.S. policy, Tiffany Wilding and Libby Cantrell. On the Federal Reserve, former Fed Vice Chair Rich Clarida. And on credit, Mark Kiesel with Sonali Peer. We begin with the big issue, the aftershock economy. PIMCO's secular outlook indicating that markets will likely face more volatility as the global economy exits a period of massive fiscal and monetary support. What a fantastic way to kick off the next 60 minutes with the PIMCO Chief Investment Officer, Dan Iverson. Good morning to you, Dan.
Good morning, John.
I can't believe it's been 4 years since we did this last time around. The last 4 years has been an absolute blur. Let's just start with the title of this new piece, and thank you for having us, of course. What is the aftershock economy?
Sure. What we're getting at here, and you suggested it in your opening comments, is that we've had massive disruption over the course of the last 4 years or so. Going into that period, we had record low interest rates. I think back in 2019, $18 trillion or so of negative yielding assets, a global pandemic, record stimulus, and inflation. And now over the course of the last 5 quarters, we've had about 500 basis points of central bank tightening, and it's beginning to impact the economy. So when we look at the world and look at the types of shocks that we felt the last few years, we think there's going to be volatility ahead. We think we're at a unique time for markets now where there's been a tremendous amount of tightening injected into the system, and you're dealing with the period now where we expect to begin to see the economy slow, certain segments of the economy surprise to the downside. It's going to lead to ongoing volatility. We've experienced it in fixed income. We expect that volatility to work its way into equity markets. It's going to create some challenges, but also opportunities for end investors.
Well, we'll talk about the opportunities in just a moment. Reading through the piece, fantastic essay, but something stands out for me. You've gone through the differences between now and maybe the pre-pandemic world, yet within the piece there is still a call for a return to target inflation at central banks, including the Federal Reserve here in the United States. There was also a call in there about going back to low real neutral interest rates. What's changed?
That's right. Now, we don't necessarily think we get back to the levels that we saw pre-COVID, but we do think real interest rates will normalize somewhere in that 0 to 1% range, perhaps a bit higher again than what we grew accustomed to for much of the last decade. And inflation, although we do expect in the base case for inflation to trend back down towards central bank targets, it too is likely to be much more volatile going forward. The balance of risks will be more symmetric going forward. So no longer do we live in a world where there's almost constant disinflationary pressure and a goal and desire from central banks to stimulate the economy to get back to target. So again, we are constructive in the sense that we take central banks seriously in terms of their desire to get inflation back towards target. We think eventually they will get inflation back down towards target. But over the next 5 or even 10 years, we're going to be in a very, very different world than the world we were in pre-COVID, where, again, these types of risks that were well contained for an extended period of time and led to a certain type of risk-seeking behavior by end investors is likely behind us. And we're going to be in a more uncertain world, a less synchronized world, and a world that's going to create, a tremendous amount of opportunity to take advantage of shifting opportunities across a global opportunity set.
Well, let's talk about those opportunities right now. Where are they for you?
Well, right now, we are a bit cautious. As we mentioned earlier, there's about 500 basis points of stimulus that have occurred in record amounts of time. This is an economy where lags are likely longer than they have during prior cycles. The household, as an example, has been able to term out debt at record low levels, fixed rate debt. So they're feeling less of an impact from central bank policy. But trouble is ahead. There's been massive growth in certain segments of the market, private credit, senior secured loans, all of which float to the funds rate, so to speak, and are feeling the full brunt of tightening. So over the next couple of quarters, we do expect to see more signs of an economic slowdown. The good news, of course, is that we've had a massive repricing in fixed income. So we think today, in terms of putting together a portfolio, investors should focus on the public opportunity set, up in quality, and that could mean things like agency mortgage-backed securities that are trading at record-wide spreads. Also, some of the higher quality, more resilient areas of the credit opportunity set. We would be much more reluctant, and we are much more cautious moving into the more economically sensitive areas of the investment opportunity set right now. And that means underweights to loans, underweights to some of the weaker segments of the corporate credit markets.
This is a fixed income house, but within the piece this morning, there is a call on equities. You do make the point that you don't believe that equities have appropriately discounted the world that you're anticipating. What is it you see there?
That's correct. I think starting with volatility, there's been massive volatility in the fixed income markets. You look at implied volatilities in fixed income, they remain quite elevated. Equities have traded very well recently. The VIX index is down again in the 15 handle type range. So we do think that within the equity markets, there's a bit more complacency. We believe as we move forward in time, and this tightening in policy begins to impact the economy with a lag, you are going to begin to see some earnings pressure within the equity markets. You're going to continue to see, and this is going to occur almost in slow motion, continued pressure on corporate credit fundamentals. So as a starting point today, when we look at the fixed income markets, you look at the yields in the front end of the curve where you can put together a high quality portfolio yielding 6, 7, 8%, even slightly higher than that. We think that's a very, very attractive relative return. More cash flow certainty, more predictability. Even historically, that's a very, very attractive return. We think equities at these starting valuations are likely to struggle as we see more signs of an economic slowdown. And I think at that point in time, fixed income not only can provide an attractive yield, but also some price appreciation potential as well.
Within equity markets, there is a big hope and a prayer on AI. And the productivity story around AI perhaps runs counter and against your base case, your central case, and a secular outlook, that we could end up with this massive productivity boom. Do you think maybe this, and I'll phrase this question in my way, and you can push back if you deem it appropriate, do you think there is a 150% rally in a single name right now that runs counter to your secular outlook?
Well, we are quite positive on AI as a technology. We've been spending a lot of time thinking about AI and already doing a lot of research in terms of how it can impact our business. And we're optimistic that there could be areas where AI could be quite enhancing from a productivity perspective. So there's certainly going to be winners in the stock market and losers associated with this new technology and the disruptive nature of this technology. Now, as a fixed income investor, disruption is not always a good thing. You better hope you are investing in credits that are not going to be disrupted by this technology. So, we acknowledge this in our research piece, that this is a significant wild card.
Yeah.
And if AI gets implemented in a manner that some think it may, this could lead to a sustained period of higher productivity. Of course, there's lots of other factors pushing productivity lower, and even productivity at the economy level isn't necessarily a great thing for financial markets, particularly fixed income, where at best you earn your coupon and you get par back at the end of the day. So the way we're thinking about AI is it's an important technology, it's a disruptive technology. We're assessing its impact from a macro perspective, but even more importantly, very focused on how it may disrupt the companies we invest in, the other business models we support across our business, where, again, you better be sure that you're on the right side of the disruption. And again, one of the reasons we do believe that the next few years are going to be much more volatile, more credit losses than we've grown accustomed to, and just more within sector and across sector volatility associated with what we think, at a minimum is going to be highly disruptive. It very well could be the type of game-changing technology that does lead to more sustained higher productivity.
Can we just go through the pockets of risk right now that you are de-risking around? Greg Peters of PGIM was on the program with my colleague Lisa a little bit earlier this morning, and he talked about how some of the risk had moved away from high yield to loans and into private markets. Is that how you feel about where the risk is right now, and are you pulling back from those areas?
Yeah, we agree with that. It's quite remarkable. We were in a very, very low interest rate period for a long time. You end up with a COVID shock where rates hit new lows, and you had households, people with mortgages, significant portions of the investment grade and the high yield universe term their debt out at record low levels and buy themselves multiple years of cushion to deal with a weak economy. On the flip side, two of the fastest growing sectors since the GFC were senior secured loans and private credit. 100% floating rate markets, which made some sense when rates were low and anticipated to never go materially higher. That entire sector today is feeling the full brunt of central bank policy. Those companies are forced to pay higher and higher debt service coverage into what we expect to be a weakening economy. We don't think this is systemic, like the challenges in subprime back pre-GFC, but those are two sectors that are going to be challenged. They really haven't been challenged for a sustained period before. We do think there's going to be disappointment there. There's going to be losses, the need to restructure debt. Stay away from those sectors today until they reprice. The other factor they have are very, very sticky marks relative to what you get in the public space. But we think this is going to be a phenomenal opportunity for new capital over the course of the next few years. So bottom line, stay defensive today, stay in the IG sector, stay in the high yield sector, but be poised to use some of that liquidity over the course of the next 5 years to take advantage of what are going to be significant challenges within that space. And again, this is moving at very, very slow motion because you don't see the price response like you see in segments of the public opportunity set.
Well, talk to me about what a cash allocation should look like in anticipation of that, and if you can throw it in there too. Are you thinking about a point on the calendar where you think this starts to bite? Because I feel like over the last 12 months, people have made this point and just keep pushing it out. It's going to happen, but maybe next year.
Yeah, so we've looked back at tightening cycles since 1950. And again, a wide range of outcomes during these different periods. But typically it's about 5 quarters before you see the impact from tightening on the broad economy. And we're right at that point today. Again, we've had record amounts of tightening over that 15-month range. So we would expect going into year end and perhaps throughout 2024, steady deterioration in some of these fundamentals. So today, from the cash allocation perspective, we love value in high-quality bonds, particularly bonds priced off of the front of the yield curve. I mentioned earlier, you could stay in very, very liquid, high-quality investments, generate 6-7%. Nothing wrong with cash here. I think it's good to make sure you're earning a full yield on your cash. But we think cash makes a lot of sense alongside high-quality bonds. And that gives you the liquidity and the flexibility to shift into what will likely be a very, very attractive opportunity in private credit, in commercial real estate. We didn't talk much about that today, but that's another sector that's moving somewhat in slow motion, but where we expect there to be some challenges and therefore opportunities over the course of the next few years.
In the last 10 minutes, I've heard a lot about being at the front end, liquidity. I've heard a lot about risks on the horizon in the economy for earnings. I've heard very little about taking on more duration. Why am I not hearing that? Why isn't this the moment to buy a 10-year at 370 and anticipate this big treasury market rally?
Yeah. Well, it's not a bad idea. I think the good news, given the massive repricing in fixed income, is that you don't have to take a tremendous amount of interest rate risk in order to generate attractive returns. I think that may be a sense of nervousness in the market. Fixed income and duration in general have performed so poorly over the last few years. People are nervous.
Yeah.
But the key point here is that, across PIMCO mandates, we're operating near neutral duration across our strategies. In some strategies, even a little bit defensive or underweight, and still generating those yields I mentioned earlier, mid to high single-digit type returns, while being able to be a bit insulated or a lot insulated from interest rate risk. So we don't dislike taking on duration here. We just think you can put together a high-quality fixed income portfolio without needing to take a lot of interest rate risk. If we see rates a bit higher from here, if we see signs of further deterioration in the economy, we will look to extend those durations. Our durations are a lot longer today than where they were just a couple of years ago. So we're moving in that direction, but we still want to provide resilient portfolios. Inflation still remains elevated. Central banks continue to be active. So we think there, on the interest rate side, just be a little bit defensive as well. The markets have done the work for us. We finally have value back in the market. Sit back and earn your coupon and get a little bit of appreciation if we end up in a harder landing scenario.
Just a final one from me, Dan, because we've got a whole host of guests in front of us where we can talk about things like commercial real estate and credit. Mark Kiesel coming up a little bit later. What's your conviction trade right now? If you had like a #1 conviction trade, what would it be?
Well, the most attractive asset on the board, at least within the public opportunities set, are agency mortgage-backed securities. They're trading as wide as they did during the COVID crisis. They're wide because interest rate volatility has been high. Everyone's concerned about the Fed selling them, the banks buying less. But you have a high-quality liquid asset trading at an incredibly attractive spread level. Again, a sector that we've been consistently adding across mandates. Not the most exciting trade in the world, but again, we're at a time when there's lots of uncertainty. It provides a steady income with prospects for significant spread tightening if the Fed begins to get closer to their terminal rate this cycle, we begin to see volatility come down. So that would be our best opportunity within the public space.
Dan Iverson, the PIMCO CIO. Let's not leave this 4 years next time. I can't believe it's been 4 years. Dan, it's good to see you.
Thank you very much, Jonathan.
Looking forward to the next hour. The conversation continues. We get the view on the U.S. economy and policy with Tiffany Wilding and Libby Cantrell. That conversation coming up shortly.
Many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from and where is it gone? Because right now it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
We think there's going to be volatility ahead. We think we're at a unique time for markets now where there's been a tremendous amount of tightening injected into the system, and you're dealing with the period now where we expect to begin to see the economy slow, certain segments of the economy surprise to the downside. It's going to lead to ongoing volatility. We've experienced it in fixed income. We expect that volatility to work its way into equity markets. And it's going to create some challenges, but also opportunities for end investors.
That was the PIMCO CIO, Dan Iverson, just moments ago discussing the company's new secular outlook, the aftershock economy. The team going on to write this morning, a new era of geopolitical tension between an established superpower and a rising rival will likely create global economic implications. Even absent a deepening military conflict, there is potential for a significant escalation of the US-China rivalry on other fronts. Been looking forward to this conversation for the last couple of days. The PIMCO economist Tiffany Wilding joins us alongside the head of US public policy, Libby Cantrell. Fantastic to have you both with us. I think this is a theme that is going to impact your world, and it starts with your world, Libby. This was a key feature of the piece. I was surprised by that. We talk a lot about US-China relations, geopolitical tension, but I think the end investor often doesn't know what to do with it. What do you think is going to change in the 5 years to come?
Yeah, Jenna, so we talked a lot about this at our secular forum. Actually, we were, I think, surprised by how many guests brought this up as sort of a prevailing theme for the next sort of 3 to 5 years. I mean, interestingly, what we're even seeing with our clients based here in the United States is that there's already a sort of a self-sanctioning in some ways of investing in China, or they're at least evaluating their allocations to China, whether existing or sort of future changes. So I think sort of from a secular perspective, difficult to know how obviously this is all going to play out in terms of increased tensions around Taiwan. But what we're already seeing with our client base now is just much more of an evaluation of their emerging markets allocation, whether they should think about benchmark construction differently, maybe think about excluding China from the benchmark. So we're already seeing in some ways the secular theme playing out today in terms of the cyclical.
It feels like very quickly this is becoming an inflation story. Tiffany, is that how you view it from your perspective?
Yeah, I mean, so I think any crisis accelerates trends that were already happening. So obviously we had the pandemic, we have the war in Ukraine, and that's just increased people's focus on supply chain resilience. And just we've called it reaching for resilience in the past. My esteemed colleague Rich, who's coming on later, will talk about the aftershocks. But certainly these trends have accelerated. And absolutely, reaching for resilience means not a focus on efficiency, and it also means higher costs. So I think over a secular horizon, average inflation above where we saw it at least pre-pandemic is a very reasonable scenario with probably more volatility around that.
Looking forward, I think this conversation shifts to the extremes really quickly, particularly around China. Military conflict, one, and you guys have pushed back against that and said that you don't need that. It could still be important and possibly important for the inflation outlook as well. But then you go to dollar reserve currency, you go to treasuries being sold, and everyone starts freaking out really quickly. Are you saying that I should be worried about the US dollar, the currency reserve status, Libby? Should I be worried about the treasury holdings over in China? This goes back to the investor conversation I was having to open this segment. What should I be worried about? Investors don't seem to know what to do with this.
Yeah, so in terms of the reserve currency, again, we talked a lot about this as well, and I think that the sort of the consensus, and which we would agree with, is that you can't replace something with nothing, right? And so you're kind of going back even to the Larry Summers quote in terms of, what are the alternatives? And I'll go even back to Bill Gross, our founder, when he talked about sort of the U.S. being the cleanest dirty shirt. And I think that was true as of 10 years ago.
It's true now?
It's true now. Now, in terms of sort of U.S.-China relationships, the U.S. policy outlook, I think we talked about the 2024 election as well. That is in some ways irrespective of who's in the White House. What we're seeing play out in Washington, D.C. as it relates to China policy, we think the direction of travel here is clear. It is bipartisan. It will be sort of independent of who's in the White House. So sort of to your earlier question in terms of kind of our outlook, we think, regardless of what the sort of political landscape here is in the United States, this will be a prevailing kind of theme in terms of kind of Capitol Hill. But as it relates to the reserve currency, no, I think the consensus, generally in the marketplace, the consensus at PIMCO is that the reserve currency is intact. Again, the U.S., that kind of the cleanest dirty shirt paradigm, if you will.
Within the piece, you talk about potentially the end of fiscal activism coming out of the pandemic, but then I noted the trifecta of fiscal issues, policies that we've had over the last 12 months, 18 months. We've done a lot still. Tiffany, why is it necessarily going to be the end of fiscal activism in Washington, D.C. if we can all agree on this massive tension, if it's the one part where we have some bipartisan agreement in Washington, D.C., why can't we do more on this front?
Well, I think, inflation is going to be a big constraint here. Obviously we have a lot of debt that's caused some consternation on the Hill, as Libby has talked about. But really, you're right, we have a lot in the pipeline, but I think moving forward, we shouldn't expect to see more. And I think this really matters over our cyclical horizon where we see a potential recession. And you're just not going to get the policy response that we've expected kind of in the recent past, certainly not the policy response like the pandemic, but also not like 2008. So from a broader macro implications point of view, that just means that, maybe we have a recession. We still think it's going to be shallow, but there's always the potential it's going to be deep. And you just don't get that policy response. So you accelerate back into something that's still below trend and still kind of sluggish.
Yeah, so I was just going to add to that. I mean, we thought one of the sort of the biggest outcomes of the 2022 election was that this idea of sort of the fiscal put, Congress sort of providing some sort of floor to the economy, was withdrawn, sort of taken off the table under split government. And we think that sort of cyclical theme will actually prevail into the secular, and Rich will talk about this, just in terms of that kind of fiscal activism on both sides of the aisle, interestingly, right? Republicans are going to want to cut back spending, but Democrats, if they should take back power in 2024, they're going to really want to focus on the revenue side. So we think this is going to be a theme not only over the next 2 years, as Tiffany said, that there's no sort of more fiscal put in the short term, but also over the long term as well.
Just quickly on the Inflation Reduction Act. I'm not sure about the title. I think a lot of people are not sure about the name of the bill. Do you think that's going to start to have a positive impact on growth, Tiffany, in the months to come, in the quarters to come?
Yeah, I mean, so I think that the bipartisan infrastructure bill actually has the potential to get money into the economy a little bit faster. You know, the IRA and some of the energy credits and things like that, I think that is going to be a more secular story. And I do think that there is the potential for it to be bigger than, you know, what the CBO or other forecasters have estimated. But there's a lot of uncertainty around this, and a lot of this is dependent on energy prices. You really need these credits to incentivize green energy, and so the relative price of fossil fuels is going to matter here. So there's a lot of uncertainty around this. We think it builds over time. Yeah, it'll provide a little bit of support in the near term, but these are still nascent industries. These green energies, they need time to grow, to really impact broader macroeconomic outcomes.
Libby, how are you thinking about that at the moment?
Yeah, so we, just from what we hear from, companies that we're investing in, that permitting reform was really key in terms of the Inflation Reduction Act. So that's actually something that we just saw from a debt ceiling perspective, that, they deserve a down payment on energy permitting reform. I think our expectations for, really kind of this bipartisan comity to prevail are pretty low, but that is one area we could actually see from a policy perspective. So we've just heard this time and time again. For the IRA to really be effective, they need to have comprehensive both federal and state permitting reform. We do think we got at least a first step of sort of a down payment on that in terms of the debt ceiling.
A big feature of the overall conversation in the aftershock economy, I think, has been the post-pandemic labour market, and wondering whether that normalises. Given what we're talking about here, Tiffany, do we have the specialised knowledge to meet the moment, to meet these kind of initiatives in Washington?
Yeah, I mean, I think there's the potential for some labor market disruption, not just with these issues, but obviously we have AI that we haven't even talked about yet. And that's going to create, not only is that going to change how people work, it's going to create a lot of new jobs that we probably haven't even imagined yet. And I think we're clearly on the precipice of that. I think near term, it's still, just from a cyclical perspective, we have industries that have underhired relative to where they were pre-pandemic. This is the government, for example. This is education. This is healthcare. Some of these service industries that are still having trouble getting workers. So that is going to be ultimately a near-term tailwind for the labor market. But it also means that wage inflation is still probably going to be sticky. And so, this is going to, obviously lead into cyclical discussions around the Federal Reserve and how tight monetary policy has to be.
And this is going to be a big conversation for us coming up shortly. Tiffany, Libby, good to see you both. Thank you. You mentioned the former Fed Vice Chair, Richard Clarida. He joins us next on this program. Your opening bell just around the corner.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
From the world of politics politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Live from Newport Beach, California. Good morning. Good morning. I'm Jonathan Ferro. Going into the opening bell, equity markets shaping up as follows on the S&P 500. Futures just a little bit softer. No drama here. Slightly negative. We're down by not even 0.2%. We're negative 0.11% on the S&P. On the Nasdaq, negative about 0.2% as well. There's the opening bell. Switch on the board and get to the bond market. Some interesting moves there. Yields at the front end around 450 on a 10-year, about 370. Yields higher by a single basis point. In the FX market, getting used to life, below 107 on the euro, 106.80, negative by about 0.3%. All of this going into the Fed's next big meeting. Of the Fed, of course, going silent with its two-day policy meeting kicking off in just 1 week. Here's PIMCO CIO Dan Iverson earlier this hour.
Although we do expect in the base case for inflation to trend back down towards central bank targets, it too is likely to be much more volatile going forward. The balance of risks will be more symmetric going forward. So no longer do we live in a world where there's almost constant disinflationary pressure and a goal and desire from central banks to stimulate the economy to get back to target.
PIMCO weighing in on the Fed's road ahead, writing in their secular outlook, quote, "We don't expect developed market central banks to formally change their targets, but do expect those targeting 2% to be willing to tolerate 2-point-something inflation as part of what PIMCO is calling an opportunistic disinflation strategy." I'm pleased to say that joining us now is the PIMCO Global Economic Advisor, former Fed Vice Chair, good friend of ours, Richard Clarida. Good morning, Rich.
Great to be here, and thanks for coming out.
Good to see you. Thanks for having us.
Yeah.
Let's start with that. What on earth is opportunistic disinflation strategy? What is that?
Well, in some ways, John, it's back to the future. A lot of folks think of the early Greenspan years in the U.S. as opportunistic disinflation, raise rates to get inflation close to target, and then basically wait for the next downturn to get it all the way to target. And we actually think it's implicit. If you look at the Fed's SEP projections, they don't have inflation getting down to 2% for several more years, and yet they have themselves even cutting rates next year. So we think implicitly, not only the Fed, but other central banks will go down that road.
So when Chairman Powell last year talked about pain, Rich,
yeah,
do we not need that much pain then? Do we just push out the timeline?
Well, I think there will have to be an adjustment in the labor market even to get to 2-point-something. You see, the challenge now, John, is inflation's running at 4-point-something. So I think that pain in the labor market that Chair Powell referred to at Jackson Hole is going to be part of it to get inflation down to 2-point-something. But the next leg may have to wait till the next downturn.
Well, let's talk about the next downturn.
Yeah.
Where on earth is it? We've been talking about this for ages now. When Chairman Powell delivered that speech last year, even when you were at the Fed, I was thinking unemployment here, how's it going to handle this tightening cycle?
Yeah.
We're going from 0 to 5, and unemployment's still around 3.5.
Yeah.
We had Dan sit in your seat a little bit earlier and talk about the longer variable lags. He said potentially they're longer. Is that how you and the team are thinking about it now?
Well, yes. Remember, we actually had a sharp slowdown in growth last year. GDP growth downshifted from 6 to 1. And it will probably be in the 1s or even lower this year. So we've had the downshift in growth. Yes, John, the surprise is the U.S. labor market is very resilient. Typically, that slowdown in growth, you would see much more of a rise in unemployment. Our view continues to be that the lags will kick in. Labor market's typically a lagging indicator. But yes, it has been a surprise how resilient the labor market's been.
The Federal Reserve is talking about a skip, not a pause. How much effort goes into a shift in language like that? To not use the word pause and for everyone to coalesce around skip?
Well, a lot of effort, a lot of discussion among members of the so-called Troika, the chair, John Williams, and now Phil Jefferson. And then, of course, it's socialized in the broader committee. But suffice to say, there's a lot of wordsmithing that goes on behind the scenes.
The potential future, almost called him the future vice chair, but he is potentially going to be that. Governor Jefferson, talk to me about how pivotal that address from him was last week. How important was that?
It was important. First of all, it was an excellent speech, and really in Phil's voice. I've known Phil for 30 years. We were colleagues at Columbia. But it did something very important, which is that the chair had tried to put his stamp on communication at an event at the Fed two or 3 weeks ago. And then, as is often the case, there's a lot of chatter from different Reserve Bank presidents and governors. And so market pricing was really all over the map. Do they cut? Do they hike? Hike 3 times, cut 3 times. And so Governor Jefferson came out and gave a very focused speech illustrating that a skip, if the committee chooses to skip, will not indicate that they're done. But they do need to respect the lags and the additional tightening we're likely to get from banking dislocation. So it, in essence, reinforced the message that the chair had delivered weeks before, and I think that served a very useful purpose because it shows that that's what the chair is thinking going into the next meeting.
Do you think this is it, the peak of interest rates of the Fed? Is that the view for you and the team?
Well, is it the peak? I think that the data's been coming in a bit stronger, and if anything, even some of the more dovish members of the committee have sounded a bit hawkish. So we could get an additional hike or two in this cycle. I think it's a closer call than I would have thought several months ago. I will say, I still think that the reasoning that the chair put forward, which is that we've had this dislocation in banking, 2 of the biggest bank failures in U.S. history. Right now markets have sort of moved on to the next thing, but some of those challenges remain. And so I think that's going to come back into the discussion at some point as well.
There were some thoughts about rate cuts. We priced them in, we priced them out. Just how high is the bar for rate cuts?
John, I think the bar for rate cuts the rest of this calendar year is very high, not only on economic grounds, but the communication's been very consistent from the most dovish to the most hawkish member. Every member of that committee has said, look, we're not going to do the heavy lifting to get rates in restrictive territory and then start to cut them. So I think the bar to cutting this year is very high because remember, the Fed has penciled into its projections a pretty sharp slowdown in the labor market. They have the unemployment rate going up to 4.5% by the end of the year without any cuts. So I do think if there are cuts, it's really a 2024 story. But yeah, I think the bar's high.
Let's pair this conversation with the secular outlook. What are they going back to if they do begin to cut? There's been a big conversation about that. We're not going back to zero. I think we've both heard that conversation a million times. What would we go back to?
Well, we did a lot of discussion and thinking on this, and of course in 2014 we rolled out at our forum the new neutral idea, which was that the Fed funds range would end up neutral somewhere in 2 to 3%. And this year we reaffirmed that view. So we do think most of the factors that kept policy rates, again, these are the policy rates when you're at full employment and low inflation. We think there's more upside risk to the inflation outlook than the real rate outlook. And so our baseline view is that Jay Powell and Christine Lagarde and Andrew Bailey and the central bankers will do more or less what it takes to keep inflation expectations anchored. But if there is a risk to the inflation outlook, it's somewhat to the upside. So we do think that once the inflation rate has come down close to where the Fed wants it, once the economy's adjusted, we think, and apparently they still think through the dots, rates are getting down into the 2s.
You share that view?
I do share that view. I think what could be different this time, this saying this time is different. I think what could be different this time is we may have policy rates in the 2s, but we may have higher bond yields. The Treasury issued a lot of debt to support the fiscal policy during the pandemic. We now have a debt to GDP ratio back to where it was in World War II, 100% of GDP. It wasn't that long ago that folks like Ken Rogoff and others were saying once you get above 100, it fundamentally changes your economy. So we do think that the Fed will probably be doing less QE in the future, what we've called QE fatigue. And we think there's a limit to how much Treasury debt investors will hold without getting compensated. So we could see a world of steeper yield curves. Right now they're inverted, but they could re-steepen.
Okay, so basically the Federal Reserve is at 2, and you're thinking about what further out the yield curve?
10-year Treasuries ultimately somewhere in the 3s, depending upon how we get to 2, and also how credible the Fed is on inflation.
They're coming out with a ton of T-bill issuance at the Treasury, hundreds of billions.
Yeah.
Now, if you're a bear, you're bearish about it, and if you're a bull, you don't really care. Give us the reality check. What do you think that ultimately means? Hundreds of billions of dollars of T-bills coming into the market all at once. How does that spill over?
Well, it's interesting, John, because a lot of the discussion until recently has been there's been a shortage of T-bills. The Treasury's doing this, of course, because we got the debt ceiling bill finally passed, and they want to replenish their checking account at the Fed, what's called the Treasury General Account. So they'll do that by issuing T-bills. That will put some upward pressure on front-end rates. Not really an issue for the Fed in terms of maintaining its policy rate, but a potential issue for the liquidity of the banking system. Because when the Treasury issues T-bills to private investors, if private investors are not money market funds, those reserves drain the system. It could tighten liquidity in the banking system. If they come from money market funds, which are investing now at the Fed, it may not. So I think there's more than the usual amount of uncertainty about how bank liquidity evolves over the next 6 months with these T-bill sales.
Do you think that's another reason to skip June, to wait?
I do not think that's another reason to skip June. I think that if they skip June, which it looks like they will, it will be basically based on the macro and inflation discussion now.
I want to finish on inflation. Just a final question. In this piece, 2 point something. That's your world. I can hear your language in there. If we set a new inflation target today, not that they're going to, you push back against that, but if we did, would it still be 2%?
Well, the way I like to put it is that if you rewind the tape to 30 years ago and central banks had sort of agreed on 3, I don't think anything would be different now. But there is what people call path dependence in policy. And having committed to doing 2, I think it would be very costly. And I think they'll shy away from formally changing the target.
Interesting. Yeah. Rich, good to see you. Great to catch up as
always.
John. Fantastic. Richard Clarida there, the former Fed Vice Chair. Coming up, time to talk markets. We're speaking with PIMCO's Mark Kiesel and Sonali Peer. That conversation just around the corner from a beautiful Newport Beach, California at PIMCO's global headquarters. This is Bloomberg.
Breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile.
So, biometrics.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
We actually had a sharp slowdown in growth last year. GDP growth downshifted from 6 to 1, and it will probably be in the 1s or even lower this year. So we've had the downshift in growth. Yes, John, the surprise is the U.S. labor market is very resilient. Typically, that slowdown in growth, you would see much more of a rise in unemployment. Our view continues to be that the lags will kick in. Labor market is typically a lagging indicator, but yes, it has been a surprise how resilient the labor market's been.
That was PIMCO's Global Economic Advisor and former Fed Vice Chair Richard Clarida on the labour market. Shifting to credit markets, PIMCO writing in the secular outlook this morning, high-quality bonds may offer long-term equity-like return potential with significantly less volatility and more downside protection than equities. We believe fixed income markets are pricing in expected volatility in ways that equity markets are not. PIMCO Global Credit CIO Mark Kiesel and multi-sector credit portfolio manager Sonali Peer join us now for more. Guys, great to catch up with you both. Sonali, I wanted to start with you and just talk about the maths of this, just the basic bond maths and why you guys believe that this year is going to be nothing like last year.
Yeah, certainly. The starting higher level of yields this year really provide a cushion. So even if we were to have some spread widening, we do see very high potential for positive returns. We've built in some lower price as well, so there's some downside cushion and some upside convexity in the bond market. Really, but the bonds have almost never looked better, given the starting valuations.
Mark, I said this to Dan earlier this morning. It feels like you and the team are throwing cold water at equities this morning. Why is that?
Well, we think you can get equity-like returns in bonds. The long-term equity return over 50 years is 6 to 7%. We think we can get an equity return. We haven't seen this return potential in bonds in 14 years. When you look at nominal and real yields, high-quality bonds can deliver equity returns with half to third the volatility. So this is as exciting as we've seen it in almost 14 years, and we don't think these yields will be here a year from now.
Is there a maturity wall that I need to worry about?
Yeah, we're actually looking at markets where we had such robust open capital markets in the back half of 2020 and in 2021 that companies really termed out their debt. Looking at even high yield markets, we have less than 20% coming due over the next 3 years, which will mean that we have a lower default rate than in previous recessions, albeit higher from here.
Two sectors I think everyone wants to hear from you and the team on: banks, real estate. Can I start with residential? Mark, we've had this conversation before. Pre-crisis, pre-GFC, you called the top. Coming out of it, you called the bottom. Last year, you kind of almost called the top again. What's happening?
Well, I think, Jonathan, what's happening is that the consumer is sitting there with 3.5% unemployment, and also you've underbuilt the housing market for a decade. What happened back in 2006 is we were oversupplied by 2 to 3 million units. And then basically what happened is no one built houses for a decade, and so we undersupplied the market by 3 to 4 million units. So the market's really being held up by very low supply. But on the demand side, these higher interest rates are going to affect people for new purchases. So the bottom line is that housing's been more resilient because of constrained supply.
Is that a story that you're de-risking around in anticipation of trouble ahead? Is that a focus for you?
What we're doing is we're focused on the sectors where we think there's going to be significant secular and cyclical growth. On the secular side, you have things like LNG and defense, where you've got long-term tailwinds. On the cyclical side, you've got this move from goods spending to services. There's still huge pent-up demand for travel and tourism, particularly on business travel. So things like airlines, hotels, gaming, we're very much invested in what we call fun. Fun is returning. People have been underinvested in fun, and so that's where PIMCO's moved.
Some of this doesn't feel like fun. Does it feel like fun to you?
Higher yields and more dispersion gives us a lot more opportunity to invest.
The banking sector hasn't been fun. One thing that I've heard repeatedly, and a lot of people have heard repeatedly on programs like this one, is I want to be up in quality. I want investment grade. And then I can show you a failed bank that was IG just a month before it failed. What's gone wrong in that sector? And what have you learned from what's developed over the last few months?
Yeah, I think it's very difficult for banks to know how long their deposit base is there, right? So in terms of understanding how much we've repriced in terms of interest rates, that steep repricing means that they needed to have managed the duration of it, right? So meaning the assets and the management liability aspect. That's been one issue, and then really deposits are the lifeline for banks. So in terms of, from here, how we evaluate banks is we continue to look at these things, what they're invested in, what their deposit base, how correlated it is, and look for opportunities really within that, right? Not all of these banks are in similar situations, and in fact, I would very clearly make this distinction that this is not the great financial crisis. This is more of an issue of, the broader takeaway is the tightening financial conditions, as opposed to the few banks that have been in a very difficult situation.
We know the regionals as a whole have a big role to play in commercial real estate, so let's tie together two themes, real estate and the banks. Mark, it's one of those things that we hear so much about. In fact, it's the number one question that people will come up to me and ask me, what are people telling you about commercial real estate? And then you get these calm, cool heads that come on programs like this and say, there's nothing to worry about, there's nothing to see. Is there anything to worry about? Is there anything to see?
Well, I think, John, just like all markets, there's going to be winners and losers, and credit is tightening most for the commercial real estate sector. You're seeing that in the regional bank, equity performance, the commercial REITs, et cetera. So this is actually going to end up in opportunities down the road for our private credit business. So we're actually very excited about it. The issue is the public markets have marked to market very quickly, so you've seen significant underperformance in those areas. The private markets have yet to market, so we actually see this as a longer-term opportunity for PIMCO.
Don't you think the repricing that's yet to come in private markets is going to have some kind of negative spillover for what develops in public markets? The losses that people might have to absorb there?
Yeah, it will, and that's why when you look at where we have been focused, we've been focused on these sectors where you've got significant improvement in fundamentals in the years ahead. I can show you many sectors where even if we have a mild recession in the United States, credit fundamentals will improve independent of the U.S. business cycle.
Name one.
LNG. LNG is on long-term contracts, and that sector will look more healthy a year from now than it does today, even if we have a recession.
We'll be sitting here in a year from now, and we can talk about it. Mark Kiesel, Sonali Peer, to the two of you, thank you. Thank you very much. Coming up, the conversation will continue. We're going to round out this hour with the man himself, the boss, the CEO, Manny Roman. Another exclusive conversation you will only see here on Bloomberg TV.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Over the next 5 or even 10 years, we're going to be in a very, very different world than the world we were in pre-COVID, where again, these types of risks that were well contained for an extended period of time and led to a certain type of risk-seeking behavior by end investors is likely behind us. And we're going to be in a more uncertain world, a less synchronized world, and a world that's going to create, a tremendous amount of opportunity to take advantage of shifting opportunities.
Just a brilliant collection of conversations this morning through the hour from a beautiful Newport Beach, California. I'm Jonathan Ferro. PIMCO publishing its secular outlook, The Aftershock Economy, writing, quote, "We see a window to step in as a senior lender in areas once occupied by regional banks, such as consumer lending, mortgage credit, and various forms of asset-based finance." I'm very pleased to say that we can have that conversation now with the man himself, the boss, PIMCO CEO, Manny Roman. Manny, good morning to you, and thanks for having us.
Good morning, Jonathan. Nice to see you.
That quote feels like your kind of language. We're going to step in. My first thought when I read that was, why don't you just buy a bank? There's many banks on sale right now. Why don't you just buy a bank?
Well, I think there are going to be many assets to buy. And maybe the best way I have to describe it is banks are going to be tight for capital. And when they're tight for capital, they have two ways of solving the problem. They can either raise more capital or they can sell assets. And the most likely scenario is there will be assets to sell in area where we have a big footprint. Mortgages, commercial real estate, bonds, municipal bonds. Dan said that earlier today that he was very keen on mortgages. There'll be mortgages to sell, and we'll be there to step in and try to buy them.
Are you looking at buying a franchise to do that, or is that just something that happens organically?
This is something that we've built over the past 20 years, and there's good news and bad news when you have a tougher economic cycle. I think the better news is that the expected return goes up and there are significant block of assets to sell. It could be, for example, equipment loans. One of the bank who was very big in equipment loans is out of business. All of a sudden, there's going to be a lot for us to do.
I hear this from other people too. I hear Apollo say banks are going to step back, we're going to step back in. How competitive is this going to be? Can you give me some size and scope and how big the pie is going to be?
It is going to be competitive because the seller has a fiduciary duty, and there will be enough for some of us to do a lot and put money to work and be patient and wait for the right opportunity to do so. And I think the cycle is usually long, and so there's no rush to put money to work. There is a very disciplined and systematic way to look at the opportunity, and some will look better than the other. It may very well be that the single best asset turns out to be real estate where we have a big footprint, or it may very well be that it turns out to be commercial real estate and mortgages and this whole segment. And
commercial real estate is something you've brought up, and I've heard it from Dan. I spoke to Mark about it just moments ago. Should I be worried about commercial real estate? Can you just take me into the halls of this place, this building? Have you all sat around a table, gone through every single portfolio and thought about what you don't want exposure to right now related to this one particular sector?
Well, I think we have, and I think we've seen the playbook before, and it is everything else being equal, a slow cycle. So the banks will look at their portfolio and slowly but surely mark their books. You have that people somehow come back to work one way or the other period where for sure there will be distressed seller and people who have the wrong financing. And I think the financing part is really, really important because it's one of the segments people have borrowed short-term is expiring, spreads are much higher, and so they will need to address the situation either by selling or by refunding at more attractive terms for us.
We've had a multi-decade bond bull market.
Campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because